Good morning. Calling to order the 10 a.m. agenda. First, we're going to hear from Jennifer Chun and her colleagues regarding the economic outlook. So good morning.
Good morning.
Happy New Year.
Happy New Year. I'm sorry, I'm a little under the weather. So I'm going to introduce you to Dr. Joe Roos. He is going to be presenting the economic forecast, and I'll be adding on about some color for the tourism portion. So Dr. Roos is going to start.
Aloha, Chair,
Morning.
Vice Chair, and members of the committee. Thank you so much for the opportunity to speak today. The presentation I'll give goes over an economic overview and also our forecast. It was very much a team effort with Acting Administrator Jennifer Chun, Dr. Reem Kamida, Jacob Billiman, and Dr. Seth Colby. I'd like to start with a global overview. This forecast is done by the Blue Chip Economic Indicator Publications, which is a survey of 50 economists that give a global outlook for economic growth. And starting with the US for 2025 and 2026 is what they call an optimistic tilt. Blue Chip has a very optimistic tilt for 2025, 2026 at 1.9%. Canada's a little bit weaker at 1.4, 1.1. Japan is even weaker yet, 1.2, 0.7. We will see strong growth from the other Asian countries, South Korea, Hong Kong, Taiwan, China. And then the Eurozone will come in about 1.3 and 1.1%. Okay, so looking at the US economy, what are the growth drivers? One of the most talked about is AI capital expenditure. This was about $371 billion in 2025, and it's expected to continue into 2026. There's strong household expenditures with the caveat that high-income households are spending much more than lower-income households. And we'll go over this in one of the slides, but high-income households have a 16.7% growth since 2018 versus lower income households, which was 7.9%. And then there's the strong asset wealth effect. Net worth of households is up, and also the stock market was up in 2025. And so that wealth effect has an impact on driving spending. The news isn't all good. There's some growth inhibitors. One is tariffs and trade policies. This is the cost of the actual tariffs and the drag on the economy, but also the uncertainty of policies tends to limit business investment when they're just not sure what's on the horizon. There's cooling labor demand, job openings are down, and so we're seeing the job market tighten up. And then immigration and labor supply constraints. Foreign-born labor force participation has been lower since, during 2025. Okay, and this I alluded to earlier, but this is just showing from January 2018 through May 2025 where the spending is coming from. As alluded to earlier, high-income households, the growth has grown 19.3%. And on the other side of the spectrum, low-income households, while still growing, has grown only 11.9% since January 2018 to May 2025. All right, and this is our our most recent economic forecast. We will update this soon, but as of the most recent forecast, one of the main parts of this is real economic growth. We forecast 2025 at 1.6%. And again, it's a forecast because those numbers are not out yet. And we show that while it will grow in 2026, the growth rate will decline slightly. The population growth will remain fairly flat through 2028. Income growth will be subdued due to tariffs and policy uncertainty, and then accelerating in 2027 and 2028. And visitor arrival growth is lower, and Director Chun will talk about that a little bit in the slides that she goes over. 2025 and 2026, visitor growth was lower, and we expect it to increase in 2027 and 2028. Yeah, one of the issues Hawaii is facing is that relative to the US, income per capita incomes have declined. They used to be above the US, and then as of 2024, Hawaii is about 5% below the overall US in per capita income. All right, and this is just an illustration of what was mentioned earlier. GDP growth is forecast to dip in 2026 and gradually recover in 2027 and 2028. Hawaii is forecasted to grow a little bit below the national growth rate. And inflationary pressures are highest at the end of 2025 and the first half of 2026, as we see impacts of tariffs make their way through the economy. And all right, and Dr. Colby is with us today, but this is GET collections are improving in fiscal 2026 relative to 2025. In looking at adjusted tax collections, they show resilience. The general fund, when adjusted for 2024 estate tax payment, is up 3%. General excise tax is up 7.3%, and individual income tax is up 2.2%. And here's some good news. In looking at inflation and employment, first of all, the unemployment rate, the most recent data, this was updated. The most recent data is 2.2% for Hawaii and 4.6% for November. That was updated within the past week, and unfortunately it didn't make this revision. However, in the Hawaii is substantially below the US for the unemployment rate. As of November, Hawaii consumer inflation was 0.3 percentage points below the nation, and that was 2.4 versus 2.7. In looking at government contracts awarded, it was increased significantly in 2022 and 2023, and then moderated in 2024. And in 2025, as of the first 3 months of 2025, it's actually down again 56.6%. However, on the other side of the coin, in looking at private building authorizations, They were actually up. This is for the first half of 2025. They were up 31.5%. Okay, so we had the One Big Beautiful Bill Act, which was signed into law July 2024. There are both stimulative and contractionary provisions. On the stimulus side, it raises the standard deduction and expands the child tax credit. No tax on tips or overtime, raises the state and local tax SALT deduction from $10,000 to $40,000. And it allows fully expensing of investment deduction. On the contractatory side, Medicaid, they're increasing the work requirement and federal match starting January 1st, 2027. And the SNAP will have tighter eligibility in addition to funding cuts. And so in looking at the impacts of Hawaii, 2025 and 2026 will show slightly improvements. However, the contractuary provisions will start to hit Hawaii harder in 2027 through 2029. Okay, and just to summarize the presentation, slower but positive growth in 2026 with a gradual rebound in 2027 and 2028. The U.S. economy is proving more resilient than expected. Higher inflation is possible in 2026 due to tariffs and then recedes in the years following. Flat visitor arrivals, but stronger visitor spending from high-end consumers will help. Constraints in other non-tourism sectors driving growth, construction and non-tourism sectors driving growth. And the AI productivity boom is expected in 2028 of 0.5%. Hawaii is growing less than the rest of the country, and fiscal transfers will have a small negative drag in 2027 and 2028. Potential risks. One of the potential risks is high inflation as it forces Fed to increase rates despite low growth, leading to high inflation and low growth or stagflation. Asset market meltdown, stocks, bonds, real estate. If they go down substantially, this will reduce consumer spending. And as mentioned earlier, policy uncertainty continues, and the tariffs could cause more economic pain than expected. And consumer sentiment is down. It was down in 2025 over 2024, and business sentiment. And if that does not improve, the consumers may reduce their spending moving forward into 2026 and 2027. Thank you.
Thank you, Joe. So we wanted to highlight a little bit more about tourism because, sorry, yes.
Can you move that a little to the right for some of us? It's easier to, if you can, point.
Sorry.
Yeah, you gotta move this screen to the right a little more.
It's gonna be in her face.
Yeah.
Oh,
Oh,
don't
you're
need my
kidding.
right
Oh,
eye.
yeah. Yeah.
If not, look it down.
That's fine. That's fine.
Ready in your grade.
Okay.
Okay. Yeah.
Thank you. Sorry about that. So we wanted to talk a little bit about the tourism forecast. And so as Joe mentioned, we are looking at pretty much flat arrivals with moderate spending growth. And the growth is being driven by increase in pricing. And the reason why I want to show you this longer term trend is, starting from 2001, we used 2019 a lot of times as a benchmark because that was the last year before the pandemic. However, it's not necessarily a goal. We don't necessarily want to have that many visitor arrivals, but from a comparison standpoint, it's good to note. So from a expenditure standpoint, we far surpassed 2019 visitor spending, but the forecast through 2028, we're not going to see visitor arrivals hit that 2019 number. And again, we don't know if we ever want to hit that again. So I wanted to show you the mix of visitor arrivals, and it's a little oval on this one, but if you look on that screen, it's a little bit more round. But one of the things I wanted to talk about is that in 2019, at the peak of visitor arrivals to Hawaii, 66% of the market was from our US domestic visitors. Now, when we look at year-to-date November 2025, we're now at 78.5%. So the difference in our reliance on that US market is really different. And part of it is because we don't have as strong a Japanese market, although it has been increasing month over month. We had a very weak Canadian market due to the different political things that have happened and also economic things. So if I look at it year to date, the recovery by market, again, we're just looking at 2019 as a point in time benchmark. You know, the US West and the US East have far surpassed the visitor numbers and the visitor expenditure numbers that we saw in 2019. Japan is less than half the number of visitors that we had at that same period in 2019. And again, the expenditures are slightly higher on the recovery because people are all spending a little bit more because everything costs a little bit more. And one of the other things I wanted to highlight was that the cruise visitors, although not completely at the 2019 rate. It's almost there, 99%, but they have exceeded the amount of spending that they've brought into the state.
Would that be affected by the change in policy about cruise ships?
It could be. Right now,
What's the impact?
we don't know how the bookings for cruises have been impacted by the change. You're talking about adding the green fee, the TAT, right?
Not just that, limiting the number of cruise ships to come into Hawaii.
Yes, Senator, that is not till a number of years later. So our forecast only goes to 2028. So the implementation for the cruise ships, I believe, is in 2030.
I don't think that's true. They're already selling tickets, bookings for next year. So the impact is going to be great.
Yes, I'm not discounting that.
If the junction does not work, it'll be greater, less cruise ship arrivals.
Yes, Senator, you know, I do agree with you that we are very concerned about the cruise ship market. I'm not trying to
Sure.
blow it off or make light of that. I'm just saying that at the time that we were doing this forecast, you know, we don't show this big growth in cruise arrivals or cruise spending. I'm just showing that through year to date November that it is ahead. And yes, there will be impacts, but we haven't determined what those impacts will be. We'd have to talk more to the cruise operators to see what their booking pace looks like.
And what kind of cuts and decline is going to be based on what we did in 2030? Because it's going to be too late to try to do anything in 2028, 2029. You have to start now to know what the impacts may be if we want to repeal it, look at it, change it, whatever, right?
My understanding is, so I'm working with the Hawaii Tourism Authority, and they have been talking with the industry and also with harbors and, you know, to look at that. But right now, we're not at a point where we have a good idea of how those bookings are declined, how those ships are moving. We're still asking for more information. And as we looked at the 2027 schedule, for example, we saw less not bookings, but what we have is this website called portcall.com. And we do see less reservations for ships in 2027 than we do in 2026. However, what that economic impact is, because not only is it we don't know how full those ships will be. You know, for example, if you
I
cut.
understand.
Oh,
that. I
yeah,
just
sorry.
wanted to know, is there gonna be the same amount of ships coming in? No.
No,
So-
no.
So you know there's a decline already.
Yes, yes,
Because if they're going from 10 ships to 8 ships or 5 ships, I don't know how many, then you know that whether they're booked in full, it's not gonna matter.
yes.
Because
There is a decline
So
in
that's
the
kind of what I'm
numbers.
hoping folks can tell us. You know,
Yes.
what is that policy going to mean as to now these ships can bring in X amount of ships, but now that with this policy, we're not going to be able to get. They can't, right? Even though they get
Yes.
for bookings, they can't.
Time
can't
will
have-
change because you never know what happens with bills that will surface.
Thank you.
But there's two different issues going on at the same
Yeah.
time. One is that the green fee and the other one is the ability to allow a certain number in.
Mhm.
So, but you're saying that that second policy isn't until much later.
Yes,
So you
but,
don't have it forecasted.
but also because we don't know the impact of like the TAT, right? So let's say that we see a decline in the bookings, like, so we know how many ships are scheduled to come in 26, but let's say there are less people. That might make the cruise ships, the cruise companies decide to do something else in out years. And we don't know that yet, what the impact of the immediate tax is versus, and then the longer term effect. So I completely agree that there will be an effect, but we're not at a point right now where we can forecast what that effect is.
But if you were to compare that to hotel room,
Mhm.
when we've increased the TAT, the effects have been minimal.
So this is my personal opinion. This is not the DBED opinion, but my personal opinion is that, with the hotel rooms, they've had a long time to understand that and have those additional taxes. This is the first time that TAT is going to be applied to cruise ships. And that might be, a difference in the way that passengers think about it, or maybe it's not. But we don't know yet because we're only a few days into the year.
Yeah. But the market has to respond. I mean,
Yeah,
the
the market has
the
to respond.
hotels, in fact, not just the increase in TAT, but they added all kind of hotel user fee and
Correct.
pool fee and towel fee. And so
Correct.
they've added a whole number of fees. I mean, even though they complain, hey, you're increasing the TAT, it's going to affect the numbers. So
So
if they want the visitor, they just don't charge some of those fees to make up for the fact that the TAT went up.
yeah, and historically, that's been some of the balance in the group markets that people have been trying to book for the convention center or citywide, having those negotiating points about not having resort fees or other things like that. And that's something that the hotels can negotiate. I don't know what points the cruise ships will be able to negotiate away in order to make up for the TAT.
Well, there's a big difference with the statute. Act 96 covers the cruise ships, all of the passenger charges.
Yes.
It's not only the cabins. And so that's why the cry is loud for the cruise lines. So if that statute was only pertaining to the cabins, I've been meeting with them until yesterday and today. I mean, they're in town. They don't mind paying the TAT only on the cabins, but the bill was flawed and it was signed, and Act 96 has to change. And no different as the chair is already talking about the hotel rooms and charging all those additional resort fees. But it's a different story with the cruise lines. They don't mind paying the TAT on the cabins, but that bill includes the entire cruise accommodations. And that's why we need to fix it. And they don't mind paying. But if it does not, if Act 96 remains, they lose the injunction and whatever, we're going to see a tremendous drop in the cruise year. I bet you that's going to happen next year. The ones who's going to suffer the most is downtown Hilo and Kauai, because the cruise ships are on the small cities. So that's my story, and it'll carry through at my committee hearings.
Thank you. I appreciate that.
One more question. Kind of changing it. So does these numbers and projections include the fact that the convention center is going to be closed down? For 2
So
years.
this slide is just a comparison of the tourism recovery. So if I
Yeah.
go back to the.
This is for past years. You don't have one. Wait, do you have one for forward years?
No, this is just showing where we are. So,
Yeah, from 2019 and then last year.
yeah. And so okay, so if you don't mind, I only have one more slide, then I can get to your question. So, the other slide that I am ending with is that from a real GDP standpoint, the non-tourism industries are doing better than tourism. There was a point in last year where we hit the level of real GDP, but it's been below that. So if you don't mind, I'm gonna go a few slides ahead to address Senator Kim's
Wait, do you have a
question.
breakdown of the non-tourism later on? You can send us.
We do have it in our,
Yeah, you can just send it later.
okay, because I don't think that it's in this,
Yeah, we can send that.
okay. Okay, so this is where we're looking at the cruise, and we're looking based on what we saw in portcall.com. We are forecasting a slightly higher visitor arrivals for cruise, but to Senator Inouye's point, things have evolved, since then that we did our forecasts, and we can expect that it would change for the next forecast. But this is where we are. This is the visitor arrival forecast by market, and then going on visitor spending. And like I said, visitor spending is expected to increase, especially for the domestic markets, because they are continuing to come, and they are, like through year-to-date November, they are staying a little bit longer, but you see a lot of flatness for the other markets, and cruise is basically flat too. So that's all the slides that we have.
Questions?
Yeah, I got a question.
Address the convention center? No? Thought you said you did that.
So, sorry, the convention center part is going back to, hold on. The thing about the convention center is while the convention center is closed, it's not completely closed. And I talked yesterday with the Meet Hawaii team, and they were able to move a significant amount of the bookings that they had for 2026 out to either single property or multiple properties, but they're still considering those to be citywide. They have another category called single property, and they told me that for 26, single property is up. So while the convention center is closed, and they are, well, partially closed, and they're more going to be for local events and weekend events. They're not going to bring in the number of room nights for the convention center itself, but those big groups have largely been moved to other properties. So we didn't necessarily lose the business for 26, and they're still working on 27.
Those single properties, are they all available on a permanent basis, or
Yeah.
what is this?
It's all the hotel ballrooms, right? You're talking
Yeah,
about.
we're talking about hotel ballrooms, and like, for example, if there was a big group at the convention center, and maybe they have to do it over several properties because they need more space than one property has, and they've booked it over a couple of hotels. And while that's not ideal for people, for the convention, but the groups have accepted that. And they've tried to move it also to large properties like the Hilton or the Sheraton.
How many business or conventions we probably lost because people don't want to do that? They might have come here, but because of that, they're not booking.
I can ask the Meet Hawaii team. Again, it's the convention center construction schedule is very important, and that's important for meeting planners who are going to book out for 28 and further to have that confidence in Hawaii and the convention center.
So for our minds, as we understand, when is the completion of the roof construction work?
My understanding is that it's done on November 1st, 2027, and that rest of that month is going to be for carpets and some painting and stuff,
The internal stuff.
right? But even though they will be completed, there are no groups, big groups offshore booked for December of 2027.
Thank you.
That's almost concerning if if the answer to Senator Kim's question is hardly any.
I'm sorry, I just don't know the number. I was told the number and I honestly don't remember what it is right now. I can get that number for you. Like I did meet with them yesterday.
But there are conventions that had to cancel because of
There are conventions that
the construction.
that did cancel because of construction, but some of them also moved to other years. So I would have to get the details for that. But my understanding from the Meet Hawaii team is that they were able to move a significant amount of 2026 bookings into other properties.
How many government construction projects you know that came in on time, completed on time?
I honestly don't know that idea.
Probably
Sir.
more so that they don't normally finish on time, right? There's
They
delays.
said
And
the medical school.
so
right?
we hopeful that it's gonna be done and ready to be booked in December.
Well, the original convention center, they said was on time and under budget under Alan Hayashi.
Wow, I don't, too many projects.
But there's no Alan Hayashi anymore.
But no, they're not expecting to book in December of 2027. The first groups will be coming in January of
I'm pretty
2028.
Confident it'll be ready by January. They haven't even come in, they have to come in for budget requests for some of their other projects because they're using monies for projects they're supposed to complete, like the escalators and so forth. And if something goes down, and they don't have the money, then I'm not sure where we're gonna be.
Thank you.
Senator Richards.
Yeah. I'll go back. You talked about the tariffs, impact of tariffs, but you sort of glossed over it real quickly. Is it because we don't know the volatility, the amount, what is going to be affected? Can you expand on that a little bit, please?
Sure, yeah, basically, it's just that we don't know where tariff policy is going, so it's extremely hard to estimate.
It's when he wakes up.
Yeah, I got it.
Whatever
No,
idea
I
comes
hear
out.
you. So the
That's
volatility of that, so that's a wild card that we have absolutely no idea.
It's very difficult to incorporate into a forecast.
All right. Thank you.
There would be like many different scenarios that
Yeah.
some you probably couldn't even imagine.
Yeah.
Senator Kidani.
Yes, so many years ago, we had programs like hula dancers at the piers when the ships came in and the Kodak Hula Show at Kapiolani Park for the visitors. That was a free show. What do we have for the visitors now?
I'd have to double check with HTA on the schedules, but my understanding is they still are doing the harbor greetings and airport greetings programs. And then I believe Kilohana for CNHA has taken over the hula show, the Kodak Hula Show.
Airport greeting, I go to the airport 2-3 times a month and I've not seen one airport greeting.
Me either.
Airport
Yeah, maybe
greetings.
if you could find the schedule of when.
I'll
we
find
visit,
out from
let
them.
us know. Thank
I
you.
know that there's supposed to be entertainment. It's not lay greetings, like, but it's,
I only see people holding placard cards with
That-
people's names.
yeah, that's not part of that.
So.
I'll ask HTA for the schedule.
Music and balls and greetings, but that's it.
I think it depends what the terminal schedule is. I see some at Terminal 1, which is
We're
interactive.
distracting from economic forecasting.
Yeah.
Versus
Yeah.
just-
I'm sorry, I'm not
Yeah.
informed about.
Yeah, we
this.
should wait. We should use those questions wait for those questions for HTA. Has there been any analysis on the strategic direction of HTA's economic impact on which visitor they focus on? Because you know, for a while, we've talked about the higher spending visitors, so which means less visitors, more spending, less ecological and environmental impact.
Mm-hmm.
But I haven't really heard that from HTA at all.
I don't think that HTA has a full study on this per se, but from what my understanding is of their marketing segmentation, they do have different target markets that they are trying to address with their marketing. But again, that would probably be better to talk to HTA about. But I do know that they are targeting specific segments.
Yeah, but if they were to focus on the higher spending visitor at all in general, and then they can break those into segments, culinary, sports, ecotourism, but they should all be the high spending visitor.
Chair, they did have a policy in early 2000 to.
No, yeah, but their plan doesn't show it.
Yeah, no, I'm just saying, and they were focusing on the business traveler. That's why the convention center and the bookings were so important, because the business traveler comes in, spends the
Yeah.
money and leaves and don't impact the environment. And
Yeah, they're supposed to be at the
Resources.
conference.
yeah.
Yeah,
But yeah, and so, but over the years, I've asked HTA about that, and they don't seem to be focusing on.
on the high spending visitor again. Yeah, because even like the destination management money, I'm not sure how that's being strategically invested to support the higher spending visitor.
Sorry, I can't speak to what HTA is doing on that.
Okay.
If you have the data, do you share that with HDA and say, this is our analysis, the higher income?
Yeah, this is
level
where they should be,
undergoing
because they're making it up
this
as
way
they go along.
So our team, the tourism research branch, does do certain amount of research for them, and we do publish it on the Hawaii Tourism Authority website. And when I talk about segmentation, each of the markets that we're looking at, and in particular, we had money to pay for the US, Japan, Canada, Korea, and Australia. And each of those teams did segment the market. Like, for example, US has like a affluent visitor, that earns certain amount, has flown a certain amount, and Japan has segments that you need to belong to a frequent flyer program and have this kind of income and things like that. So there is that kind of segmentation that they are looking at. However, I can't speak to how their campaigns are aligned with that. And of course, I do provide that to them. It's
Is
on,
there research on the segmentation? So what are
Yes.
their interests or a survey?
Yes.
Anything that
So,
you guys do or?
yes, and
HDA do?
so we do it and we publish it on their website, and we do have what we call traveler profiles. And we have monthly traveler profiles for the US, quarterly traveler profiles for Canada, and twice yearly for the other markets. And it talks about the things that they value with their travel decisions, how Hawaii compares to that, what the different market segments that HTA marketing partners have defined, and how those people value different things. So we do have those, and it is published and available to everyone on the Hawaii Tourism Authority website.
And is segmented by income level?
It has the income profiles that they chose. So some markets chose like 3 profiles, other markets chose maybe 2 profiles, but it also has a comparison to what we call the national rep. So it's like all the markets, not looking just at their segmentation. And we have that information also. And like I said, we have it fairly frequently. We also do additional US market research for them.
And it's shared with HDA, so. you
Yes,
plan-
and it's also on the HTA website for other people to use.
And then you talked about the increase in AI.
Oh, yes.
So has this, just like how we're asking questions on tourism and HTA, the data that you provide, do you do the same thing for HTDC?
HTDC does a
Or
survey.
NELHA?
NELHA, we do help HTDC. They do a survey and we help them with the data analysis.
I'm just wondering if, I mean, they need to be prodded into investing in the right things or expanding the right things that we know are going to be able to grow our economy, which I don't see them doing that either.
Yeah, I'll definitely reach out to them.
Yeah, I mean, you guys are all DBIT, and so that's where I'm not sure why, at least guiding them to say, look, this is where the low-hanging fruit's going to be in the future. Are you guys should move in this direction? I don't necessarily see that.
Understood.
Yeah.
Thank you, Chair. Just a couple questions. I'll get back to the convention center, since that's been a issue for our state.
Are you talking about construction or the economic?
Construction, I think, no, that's the guarantee.
So if it's construction, let's wait for HTA. If
Okay, yes,
economic,
what about the roof? That's why.
Dave brought it up, but it's really
Okay.
about the economic impact.
Okay, I got
Because he-
something else then.
Okay.
Okay, so if the tariffs is struck down by the Supreme Court, what is the potential impact for our Hawaii economy?
That would reduce uncertainty. One of the issues with the tariffs is that in order for the economy to flow, we need trade flows because supply chains are so globally intertwined right now. And so, Senator, I think in answer to your question, the biggest impact would be a reduction in just uncertainty so that businesses can plan their supply chains.
So why is job creation so weak in Hawaii, and what would be driving the weak on job creation?
I would say that job creation is in the sectors. One is we're seeing slowdown in tourism, and actually 2025 will have fairly good job creation, but looking into 2026, we're forecasting a little bit slower job creation. A lot of it is we still see growth, but the growth rate will slow down. Some of that is tourism. Some of it is a possible slowdown in the non-tourism sectors. But for 2025, although the final numbers aren't out yet, we expect it to be fairly firm.
Because you said earlier that our unemployment rate is down compared to the United States, right?
Yes.
So if it's down, then what is the creation to keeping us down that we're having jobs moving forward? If you're telling me tourism is going down and we don't have the job creation, why is our unemployment lower than the United States? If we're not having job creation?
Yeah, that's a good question. Moving forward, we'll see job creation, but part of it is the size of the labor force and labor force participation. Labor force participation, one of the big drivers is retirements. And as baby boomers retire and move out of the workforce, the labor force participation rate goes down, which impacts the unemployment rate because there just aren't as many people in the labor force as there used to.
It's one more, and I'm done. So you talked about foreign-born labor.
Right.
What are we doing to keep local-born labor employed or attractive? Because, we're worrying about the foreign labor, but what about investing and try to do something for the local labor? Because every time I hear this, I don't hear nothing about that we're going to try to build up the local labor force. We're worrying about the foreign-born labor that is leaving or not going to be here to some kind of whatever is happening in the continent. But again, what are we doing in the forecast of trying to keep local labor and working on having local labor instead of we worrying about the foreign labor? Because I don't see that.
Yeah, that's something that I'm not sure if I'm the
That's
best
kind of
person.
people leaving the state with
Yeah.
the jobs. Not only the economy is not having jobs or a workforce, so they're leaving to other areas to get jobs so that they can provide for their family, not because the cost of living is high too in Hawaii, but there's no jobs. There's only certain jobs like construction. What are we doing with the other industries? You know, for the.
Traditionally, all they do is analysis of what's going on, right? We have not directed DBED to say do the economic analysis on which industries in which regions will create local jobs in that area. They have not, it's not as proactive as we would like. So there's enterprise zones. I don't know any analysis of the enterprise zones and the impacts of enterprise zones. There's foreign trade zones. I don't know any analysis of the foreign trade zones on the different regions. They may have state numbers, but they don't have it like how it impacts Hilo or how it impacts, Kalihi or how it impacts. And then we looked at the different things about enterprise zones. There's no enterprise zone for film. There's no enterprise zone for energy. That's where some of these corporations and authorities have to get on the ball because they're not expanding. They're there to grow the economy and to create jobs, and they're not doing it. These guys are just now they look at the information, they crunch the numbers. They don't necessarily have the authority to do what HTDC or NELHA or ADC or HTA can do.
They can be directed to get the data to give.
No, that's why I'm saying the legislature should direct them to do that.
I guess because I heard them say about that, the reduction in foreign.
Yeah, that's just
labor.
the analysis that because of the current policies, we can't bring in foreign labor for things that we normally would, like agriculture or sometimes construction or things like that, but maintenance. Okay, thank you.
Thank you.
Thank you.
Okay, we're gonna just take a 5-minute break so that we can have Dr. Bonham set up. Okay, recess. Okay, reconvening. Okay, next we'll hear from Dr. Carl Bonham, who will present on behalf of UHERO. So good morning.
Morning. Mahalo. Thank you, Chair, Vice Chair, members of the committee, the opportunity to present our very bleak outlook. Actually, I would say I'm feeling a little more optimistic than we were when this report came out. And there's a lot's changed since then. So when we first released that forecast, we were missing a whole bunch of data. And as that data has come in, I think the outlook has improved a little bit. And yeah, so we'll be updating the numbers, and I'll talk about this, where those changes are as we go through. So whether our next forecast report says there's going to be a recession or not is an open question. I think actually Jen may have showed a slide somewhat similar to this. The whole point of this slide is just to illustrate that Hawaii essentially has the vast majority of its eggs in the US basket, if you will. And so if you look at the left pie chart, think about the components of that are really driven by US economic activity. It's tourism. And the tourism share of GDP, this is from 2024, that data is a DBED number. It's down a full percentage point from where it was the previous year because of the wildfires, because of the lost spending on Maui. But 16% of the Hawaii economy is directly related to tourism. And if you look at the right pie chart, you can't see the number because the screen's too dark, but the number is about 79% of visitors, this is actually average daily census, are from the US. The big blue wedge, that's the US, right? And CA is not California, it's Canada, 6%, Japan, 5%, and other 11%. So essentially, on the tourism side of the economy that makes up roughly 16% of our economy, almost 80% of that is US driven right now. And then on the other pieces, the other big pieces of the economy, state and local government and federal, right? You put those together, you get almost 20% of the state economy. And both of those are heavily reliant on, obviously, federal is completely reliant on what's going on with US policy. And obviously, much of state government spending and some county government spending is also very reliant on federal spending, all of which we know are under threat. And so basically the overall growth of the US economy and to some extent the Hawaii economy have continued to be a little bit stronger than I think most of us thought would happen. Maybe a little bit more resilient.
Wait, I got a
Oops.
quick question.
Yep.
So when you look at the overall pie,
Yeah.
if tourism went down 1%, which other industries absorbed it?
You mean if tourism went down 1%, but the economy stayed the same, which other industries absorbed it? Well, in this year in particular, it's been, I'd say that the biggest growth factor has been construction, right? You look at construction job counts, and we got the jobs numbers today from the BLS, and construction is still at record high numbers. Construction jobs are almost higher than federal civilian jobs at this point. So we actually saw a 2,000 person loss in federal civilian jobs in October when the early retirement stuff finally showed up in the data. And federal civilian job numbers are roughly 30,000 right now. That's the lowest they've been since 2008, 2009. In contrast, construction basically keeps going up. The other sector that has been quite a bit stronger than we expected and is in a big sector is healthcare. So we were, and the reason we were anticipating a weaker picture for healthcare is because it's not just hospitals, it's healthcare and social assistance, right? It's all of these nonprofits and agencies that rely on federal support for providing services. But we haven't seen the kind of job losses there that we expected, or they're being offset by hiring in the hospitals, for example.
Carl, does it
Yep.
show the source of where it's coming from? Is it private? Is it government,
So
federal?
all of this is private. If it doesn't say federal or state, it's all private.
So even
Now, that doesn't mean all the money came from, right? So you could look at healthcare is 7.5% of Hawaii's GDP in 2024. A lot of that money is coming from federal
but
funds,
it
right?
doesn't, you can't segment the federal to state or federal funding.
Yeah, but Carl, on the construction part, that's cyclical. I mean, it's not gonna be.
And I've got a forecast chart that talks, so, and there's another example of where the bulk of that money is coming from federal, right? So that's the one area where federal spending, and actually when Joe was presenting, he was talking about government contracts awarded. There was a $8 billion contract awarded by NAVFAC in May or June, and for some reason it hasn't shown up in the government contracts awarded data. There were press announcements, and I've talked with Hawaiian Dredging and others, and they're expecting that money to flow. And so that's an award that happened this year, but the spending is going to go on for the next 4 or 5 years. Same way with some of the work that's going on at Pearl Harbor, right? It's not going to end this year. And so in our view, the construction sector continues to be a resilient piece of the overall forecast.
Because a lot of condos are being built. Some high-end condos, is gonna be a flood of inventory, whether or not it's gonna sell or not, and that people might not be building if there is a glut.
I mean, I guess I wouldn't characterize us as being in a situation where we're going to have a glut. If you look at the sales records of the people who are building those high-end condos, they're pre-selling them. And they, in many cases, they have to pre-sell a large percentage of the building before they can get their financing. And I'm not hearing any news about people backing out. That's always a risk, right? You could have people backing out. But I guess I'm not. That's not something we're building into our forecast. It's a possibility.
Understanding is these contractors have put in affordable units, and the affordable units are not selling.
That's different.
Right.
So yeah, that's a very real possibility. Yeah.
Terms and so forth is really not affordable.
Right.
So those units are sitting there. That's gonna have an impact.
Yeah, but as you know, the way that it works is basically the market rate units is what carries the building. And, not selling the affordable units is important. I don't know if we'll see an experience like we have in the past where when those units sit long enough, then the rules start to change. I don't know if that's something that will happen again. Yeah, it's a real problem with interest rates the way it is, and with that the affordable units are not accessible to a lot of households.
Can you just pull up on that for a sec?
Yep.
This may be a separate discussion with a different agency, but lately, just in the whole universe of available, I should say planned affordable units that are in that pipeline, or even, like 5 to 10 years out in some prospective pipeline, the number that are now being planned for with various credits and things that are concessions, right, when you're developing like a luxury apartment or whatever. If those are being transferred into, for example, like DHHL or one of the other agencies that already have a mandate to build housing, does that change the overall number of units in that pipeline, or change the?
Wow, that's a really good question. I really don't know the answer to that. Okay. Yeah, good question.
Thanks.
Food for thought too. Thanks. So this is just continuing on the same theme, but for our reliance on U.S. visitors, and Jen actually showed some numbers that were similar to this. So these are visitors from different markets, all indexed to January of 2020, right before the pandemic, right? So everything starts at 100, and so the blue is U.S. arrivals, and as you can tell, that's above 100 almost over this entire time period. So it's really the U.S. visitor that came back in the revenge travel days with, using U-Haul rental trucks on Maui to get around, but they've stayed, right? So we're still at about, I think we're 6 or 7% above 2020 levels. These are number of people. And even with some growth that we've seen from Japan over the last several months, Japan is still languishing at sub 50%. So basically, this just gets to the same point that if the U.S. economy weakens or were to have an outright downturn for whatever reason, Hawaii is in a fragile place because of our reliance on this. Is the stuff that we worry about, right? It doesn't say that that's going to happen, but the other markets, particularly Canadian, right, is down sharply this year and isn't likely to take up the slack.
And I understand not only the Canadians, but the European travels, which is the high spending, like Japan, the Japanese that come into Hawaii, but this immigration thing that has been set up is just killing the European travelers.
It's the overall international is primarily being dragged down by Canada, but you're right. It's not just the Canadian. And I will comment on one thing, is that the Japanese visitor is no longer the high spending visitor, at least not in dollars, right? So really, right now, the U.S. visitor is actually the high spending visitor, surely not the Canadian. And we've been digging into this a fair amount, trying to understand why visitor spending is going up primarily in the last 3 or 4 months, when the number of visitors has been falling. Right. So if you look at the average daily visitor census for the whole year, it's basically flat. I mean, it's gone through cycles, but we don't have more visitors here. The hotel room rates are not up. Occupancy rates are roughly flat. But for some reason, visitor spending has shot up over the last 3 or 4 months. And we haven't figured out why. I mean, in the data, the data suggests that visitors are spending the growth rate in visitor spending per person is growing double digits on things like eating at restaurants, renting cars, and shopping. Even while prices in those areas, if you look at other sources of data, consumer prices, for example, for food away from home or transportation, are not growing anywhere near that rate. So you have flat visitor numbers, but visitor spending shooting up. And hotel rates are basically flat. It's Excuse me. It's pretty puzzling,
Well,
actually.
maybe it's not flat, but maybe it's just expensive historically. Have you looked at
But
that?
it's not, I mean, so year over year, hotel room rates,
But not year over year, but over a trend of time, a period of
well,
time.
they're certainly not flat over time, right? I mean, hotel room rates.
Because my sense is at a point, it's just so expensive to stay, right? And so you're just attracting at a certain point the higher spending visitor anyway, because you have to have so much.
Well, so I mean, the first question is what's going on because we're seeing a higher spending visitor.
Mhm.
But if we were seeing a higher spending visitor, you would think that we would see
Higher
room revenues, right? So in other words, the higher spending visitor stays in a more expensive room.
No, what I'm
and-
saying is it was already high, so you had people with revenge travel money paying the higher rate, but it was just now it's.
But then it would be so because the visitor numbers are flat, you would, if you have more people who are higher spenders, you've got to have fewer people who are lower spenders, and the average should be falling, and it's not. So
we've got to figure it out what the formula is, right?
So that means there's room for us, for HTA, to really focus on the higher spending visitor.
Well, I think there always is. Whether or not it works and whether or not that's what they're doing, I can't answer that.
Sorry, real quick.
I don't think so.
You have the data that shows that US is the higher spending.
Yeah, if you look
visitor.
at per person per day spending for US visitors, you can see it on our data portal. It's probably on one of DBED's dashboards, and it's I'm going to say $290 a day, something like that. In Japan is probably $260.
Yeah,
It's
because
not
according
huge
to DBED's report in October, the number of visitors went down, but then spending went up.
Spending went, yes. Yeah, the spending numbers for the last 3 months have been surprisingly strong. And
Compared to the past high spend.
well, so I have a slide about real visitor spending at the end of my, and so when you look at spending over time, it really doesn't make any sense to look at the nominal numbers, right? Because we don't care if spending goes up because prices went up. That doesn't, price increases that are coming from tariffs or oil or general inflation, they don't help the economy. That's just dollars. And so if the business is charging more, but all their costs went up, they're not thriving, right? They're not going to be adding workers. And so you really have to deflate. And when you look at in real dollars, visitor spending is not up. I mean, it is a little bit the last 3 months, but say compared to 2019 or 2021 or 2022, it's not. So staying on the theme of dependence on US, this is what, for the US economy, it's kind of a story of is the glass half full or glass half empty, and the labor market is half empty. Overall GDP growth is half full. The risk that we've been focused on is really from the labor market, and basically we focus on just the horizontal lines. So in 2024, before data revisions, the US was adding 170,000 jobs a month. After the data revisions, and this is a preliminary data revision, we think the US economy added about 110,000 jobs a month. When you take into account the data revisions, right, every year the data gets revised. And no one's making up the numbers or anything. It's basically the preliminary data is all based on a survey. The final revised data is based on essentially UI claims, or not UI claims, but the entire population of people who are eligible for UI insurance. So we actually know how many people are working. It just takes time for the data to get adjusted. So using the adjusted data, and basically since Liberation Day, I don't know why I called it that, but since April, the US economy has been adding about 17,000 jobs a month. So effectively, and you can see the blue bars bouncing around, right? Some months are positive, some months are negatives. So essentially, the US labor market is basically at stall speed. And it's that fragility that makes us worry about. I mean, it wouldn't take much to tip those into negative territory. And as Joe was talking about, the US unemployment rate has risen to 4.6%. and that's what's underpinning, we think, some of the weakness in tourism that we saw this year.
Federal workers are all losing their jobs.
Yes. And actually the big negative there, the minus 90,000, I think it was 99,000, a whole bunch of that was federal. Right? Most of it was federal. And in October, as I said, we saw about a 2,000 person loss of federal civilian jobs in Hawaii.
But then Hawaii is still one of the lowest states with the lowest unemployment.
Hawaii always has the lowest, not always, that's too strong. Hawaii is almost always near, let's say, the bottom 5 for unemployment. The only time, and it has to do with the structure of our labor market, and it's generally true, and it is also the case that we are adding jobs. It's not that we're not adding any jobs. We're adding jobs at a slow pace, but we're adding them faster than we're adding labor. Right. So with the age of our workforce, with people moving away because they can find better jobs, higher paying jobs elsewhere, our labor force growth has been much slower than even our slow job growth. And as a result, the unemployment rate has slowly fallen. So sometimes the unemployment rate is a really good indicator to tell you about the strength of your economy. Sometimes it's not, right? You could have an unemployment rate that's very low because everybody left and there's nobody around to work, right? So you could have a very low unemployment rate then. So Joe talked a little bit about the chaos that's been created by the tariffs. And so this is just a plot of how much the tariff rates have changed since the start of the year. Right, so the average effective tariff rate in the US was about 2.5% at the start of the year. It got as high as almost 30%. Right now, we're at about 17%. And then there's all kinds of exceptions. And so like if you make computer chips in Taiwan, your tariff rate is not the same as the overall Taiwanese economy. But this is creating a tremendous amount of uncertainty for businesses and is playing an important role in why the labor market has slowed so much nationally. The SCOTUS decision, I saw a headline the other day, I didn't read the story, that said they might actually release their decision on Friday. So, what that effect will be in Hawaii and elsewhere is kind of anybody's guess. My guess is that if they were to say, okay, you've imposed these illegally, that the Trump administration will choose to essentially impose similar levels of tariff using legal means, because there are 4 or 5 different ways that you can impose tariffs. The reason they went the way they did was because it was fast. You just declare an emergency and you go, right? Canada's sending all their fentanyl to the US, so just impose a big tariff on Canada. The other ways take much longer. So I don't think the uncertainty is going to go away, but we might see an initial reprieve. And it's possible that some Hawaii businesses would get money back, right? So it's really hard to say, but it's creating a situation where the labor market in the US has been very, very weak. Investment outside of AI has been very, very weak. And consumers are about as pessimistic as they have ever been, which is pretty fascinating. It gets to the point that basically the very top of the income distribution is thriving, right? They're seeing big gains, big stock market wealth gains. They're not worried about losing their jobs, and they're doing great. And the rest of the population is struggling with rising prices. Yeah, egg prices have come down a little bit. Gas is still above $2 a gallon in most places. But overall, the cost of living is a challenge for the middle class and even above. And that's where you get the pessimism. The growth that I just mentioned in stock market wealth, the top line shows the change over time. It's the level. It's measured on the left axis. But we've seen tremendous growth in stock market wealth as opposed to the sort of slow plodding growth of personal income, which is the bottom line on the right axis. And that's driving high-end consumption, which may be contributing to the higher visitor spending in Hawaii. I have no doubt that it is. I'm not sure it's enough to explain all of that. I'll just tell you what this says. You don't need to. Basically, The dark blue bar, if you look at the 2025, those are the first and second quarters of 2025 on the far right side of that graph. The dark blue bar is AI investment. If it weren't for it's information processing. So if it weren't for investment in data centers, overall investment in the second quarter of 2025 would have been negative. I mean, if we didn't have that, or at least much, much, much smaller, right? If the number had been compressed. And so essentially US growth is heavily dependent on small pieces of the economy, AI investment, high-end consumers. Now, we're going to get a boost from tax. Joe had a slide where he talked about the benefits of the tax cuts, and those are going to be real. They're going to impact Hawaii. They're going to impact the US. People are likely going to see larger tax refunds this year from federal tax refunds and some state tax refunds as well, because of tax law changes that weren't fully taken into account in withholding. And then that money will start to flow throughout the US economy and Hawaii's economy and contribute to a little bit stronger 2026. So this is similar to Joe was showing data from Blue Chip. These are our forecasts. We've revised our forecast for 2025, and we can say it's a forecast because we still don't have, it's actually an estimate. We don't have the full data. The dark blue bar is the United States. Our estimate for 2025 that we're working on for our next forecast release is closer to 2.2% growth, higher than the Blue Chip forecast. We may have more data than they had when that Blue Chip number came out. And our forecast for 2026 is about 1.9%. So we don't have a forecast for a US recession. We think that growth is fragile because of the concentration of the growth coming from investment in data centers and high-end spending. So you could imagine if you want a worst case scenario, instead of the stock market growing 15% in 2026, it falls by 10%. That is a very different. It falls because NVIDIA stock plummets, and then that translates into much less consumption by high-end consumers and possibly less investment in data centers. Yes, Senator.
So the drop in the mortgage rates are part of that economic forecast.
Well, except that at least in our forecast, mortgage rates were barely budging. And so we would be in much better shape, more widespread spending. And really, if you look at housing and housing investment, that previous slide showed housing investment being very weak. It was a little bit better in the third quarter, but in many parts of the country, you could argue housing is basically in recession. And that's certainly the case in Hawaii in terms of the overall condo market, right? With very, very little activity there for a whole variety of reasons, high HOA fees, problems with insurance, et cetera. But the mortgage situation is part of that. Even if the Fed lowers interest rates by 2 or 3 times next year, we don't think the mortgage rate is going to come down very much. It will come down a little bit.
Better next year?
It is. But you can actually get perverse effects where the Fed is lowering interest rates because they think labor market's weakening. But if inflation is staying high and people are worried about long-term debt, then the 10-year bond rate stays elevated, even goes up. After the last Fed cut, the long rates went up, right? And you can have mortgage rates going in opposite directions.
Yeah, so no, I just kind of, I want to top on, you keep talking about Canada and the US mainland and, what's causing the decline in tourism in the state. But, you don't get into the fact that Canada have carbon tax fees. Their economy is driven because of the stuff that they implemented on themselves. You talk about tariffs and stuff like that because you said the emergency tariff with fentanyl, so they did that. But Canada and some of the other countries, are we looking into why the decline is declining? Because you're saying the United States is going up, right, in the tourism. But Canada, do we look into why Canada not coming? Because you talk about that, the US is coming and the cost and everything, but do you look at their economy?
Of course.
The economy is carbon tax. They have a lot of carbon tax taxes and a lot of the economy of the food, their gas, the fuel, all costing more money.
So the reason that the Canadian economy was as weak as it was in
Yeah.
2025
Yeah.
was because of trade. So that and they had one negative quarter of GDP growth, and that was completely trade driven. In other words, less exports to the United States. And I mean, yeah, everything matters, right? Their tax structure matters, their labor markets matter, but when you have shocks like the tariff chart that I showed, that's the immediate impact. Their economy recovered a little bit in the third quarter. I think it was stronger, but Canadian visitors to Hawaii have been in decline since the wildfires. So this is not just about what happened in 2025. We lost roughly 10% of our Canadian visitors in 2024, and another roughly 10% in 2025. So it's not just, about one bad year of Canada. It's also about the fact that they were big visitors to Maui and they didn't come back after the fires.
Well, I'm not just talking about Canada. You're talking so much about the United States, which is great. That is Australia and Japan. So you dissected Canada. So are we dissecting all the rest of the
Yes.
people that is coming?
Yes.
So why is it?
But the point is that the reason I'm talking about the US is because they're 80% of our visitors.
Yeah.
So yeah, all the other ones matter. Okay. But
do we know why the decline in Japan and Australia?
Japan's rising. So Japan is actually seeing pretty significant increases in Japanese visitors over the last 5 or 6 months. And I can't remember. Most of the international decline is Canada. So the other international is down a little bit, but not nearly as much as Canada.
We spend a lot of money advertising Hawaii in the Asian countries.
I don't know how much money HTA is spending on which country.
Okay.
So we can ask the spending of HTA.
So on a positive note, we don't know why, but real visitor spending has bounced back after hitting so this is real visitor spending. So here we're deflating with the Honolulu Consumer Price Index because we have that data for 50 years. We can and it's the only consistent price index we have. So after a very, very weak summer, you see the sharp decline where we tested the lows of visitor spending post wildfires. Over the last 4 months, real visitor spending has rebounded. And as the subtitle says, our visitors really spending 15 to 20% more on food, entertainment, and transportation. I don't know, but that's what the data says.
Well, if you trust your data,
it's not my data.
It's so sharp a decline in 20.
Well, so that's the other thing that's going on in the tourism data is it's become more volatile. So over the course of 2025, right, we saw a really strong start to the year and then a really sharp drop in the summer, and now we're seeing a rebound, and it's unusual. So I don't know what's driving that. We tend to interpret it as being driven by actual visitor activity, but there's other things going on as well in measurement, and I can't explain it, but I do know it's more volatile than normal. So basically, that's our last forecast. It just shows that we were anticipating so after the sharp drop, which you can see at the top, the dark blue line is the whole state, excluding Maui. We separated out Maui because it's undergoing a different dynamic. It's still recovering from the wildfires. And so Maui really just sort of weakened in 2025. The rest of the state, particularly Oahu, saw a sharp decline in the summer. And then our forecast was for a fairly flat, prolonged recovery. The most recent data tells us that the Oahu is still the big drag, and yet visitor spending is rising across the state. So that'll all get revisited. This chart, which I had updated, I updated on my computer, not on this one, and we actually just got today 2 more data points for jobs, and the dark blue line. So the dark blue line is payroll jobs. total statewide payroll jobs, federal, private, everything. And with the next two data points, the line ticks up a little bit. We're almost back to where we were at the beginning of the year. So that spike that you see, that's January 2025, we've almost recovered to that level in November. And this is data that these are our estimates of payroll jobs. So we take the data that the BLS produces and in DL, I guess it used to be DLIR, it's now DBED. It has a collaborative arrangement with the Bureau of Labor Statistics and helps produce that data. What we're doing is we're adjusting it for the revisions that are going to come, and we won't get them until March. But we have the data that they use to do the revisions. So our data looks very different than the preliminary data. The preliminary data would tell you we've seen almost 2% job growth this year. Our estimate of the forthcoming benchmark revisions say we've averaged less than 1% job growth this year. It's a pretty big difference, just like it was for the US, right? And that's been our primary concern and what led us to essentially forecast a mild recession for late 2025, early 2026. So another data point that's come in more positive, the gold line here is job openings. This is from the Bureau of Labor Statistics Job Openings and Labor Turnover Survey. We just got that data, I think, on Tuesday, and those job opening numbers bounced up for October. They're still at a level, so if you look at the horizontal line there, it's at 100. This is indexed, so it's not actual number. It's the actual number of job openings indexed to February of 2020. The job openings from BLS, the gold line, is at the lowest point it's been going back to 2018, 2019. Right, so you can see it fell dramatically during the pandemic. I guess I might have a pointer here. Oh, I do. Can't see it on Zoom. But the job opening numbers are now up out here, roughly the same as what they were back in 2019. And the reason that I highlight that is just that, I mean, I think there's some reason to be concerned about the increase in the minimum wage. Not from, I mean, obviously, if you have a job, it's going to help, right? If you don't have a job, or if you're a new entrant, or you lose a job, I think in the current environment of weak job creation and minimal job openings, it's going to be harder for entry-level workers to find work with that $2 minimum wage increase. I'm not suggesting that there's anything we can do about it, but it's something to be aware of.
Doesn't it go up some more?
It went up on January 1st by $2, and 2 years from now it'll go up again, and then it stops.
It goes up again.
Another $2. Yeah, it'll stop at $18 an hour.
Well, that line could get even worse.
Yeah, I mean, assuming that, I mean, if the labor market recovers, right? The last time it went up to $14 2 years ago, but that was in the middle of the post-pandemic hiring boom, and very few workers were actually earning less. We're earning the minimum wage at that point, right? Because, you know, Zippy's was offering $1,000 hiring bonus, and they were paying more than the minimum wage in order to recruit people. But we're in a different labor market now. I think, if I remember correctly from our forecast report, our estimate was that about 50,000 workers would be impacted by the wage increase, right? So they were earning less than the $16 minimum that we now have. And so they would see their wages go up, and that gives you an idea of the overall impact on the economy. But if you went back to 2022, the number was much, 4,000 or 5,000 maybe workers would have been impacted because everybody was already earning more.
There's that unknown factor about how many restaurants or stores will close.
Yeah,
What we hear
no,
about
absolutely.
restaurants, I think they're already talking in their own circles about getting out.
Well, so they will absolutely be looking at ways to conserve on, right? I mean, they're being hit, restaurants, retail, everybody else is being hit with cost increases all over the place, right? Whether it's because of tariffs or it's because of health insurance or it's because of overall insurance. All those costs come into play, and then you add an increase in labor costs. They're definitely going to look at ways to cut costs.
You know, your statement on it's going to be harder for a new employee to get hired with the minimum wage.
Entry
going
level,
up. Yeah,
entry level, non-skilled.
yeah.
Yeah,
So it's basically the fact that they're non-skilled. That's the.
yeah. I mean, well, it's not necessarily not skilled. It's just who, what are the characteristics of a worker who might be earning $14, $15, $16 an hour, right? 16 now, right? And that's the lowest entry wage you can have. So think about a teenager who is looking for a summer job.
Yeah. No, I'm just trying to work backwards in that sense where how do we make sure that our programs like Community School for Adults or
Yeah.
DOE does provide the training to mitigate what you're saying.
No, absolutely. Yeah. And I actually think we're working with Department of Labor on some analysis
Because
of
it goes
the
back
work
to
training programs.
what
And
Manager Favela had said, well, how do we help locals get these jobs? So that means we have to provide the training and make those investments so that class of people can.
we're recruiting right now. And if I remember correctly, some of the people we've been talking to have been doing some really interesting stuff on job training programs nationally and how effective they are. So I'll share that paper with you.
You don't have that broken up by zip code, do you? That information.
Work trainer programs.
Where the population is of people, or could be, I don't know if it's even possible, where they're having a hard time getting into the entry level jobs because they don't have the training. Because then we can be very specific with which school or which program. But if it's, I don't know, so you can think about it. You can think about it.
Summer hires.
That's one, he's saying.
So
Yeah, that's one. But if there's a clue on.
Oh, you could also just, think about counter help in a restaurant, right? Back counter, people who are chopping vegetables, right? They lose their job. Then are they going to be able to find a job back?
No, so that's where the jobs are. What I'm trying to figure out, where are the potential employees? Are they in low income communities where in that sense we could provide the training in that specific community? They're going to have to commute to the job, but.
Yeah, we'll give it some thought and see if I'm not sure that we could come up with that kind of data, but it's worth thinking about.
Yeah.
So are the jobs also by different geographic areas?
Oh, sure.
So
Yeah.
that you can see what
Oh,
the
you could
amount
match them up. Yeah.
alignment.
Yeah. The different training, different job.
Jobs with a minimum requirement. This could be like dishwashers,
Sure.
right? So
Yeah.
how much training are we
Yeah,
requiring?
no, that's not going to, right. It's really about training that takes you out of the dishwasher job and into maybe you run the cash register or whatever the skills are necessary to get in.
Because you want, I think
really,
you want to move people up the ladder so that you free up that job for someone who doesn't have skills.
And you send them to UH.
If they can afford it.
There you go.
But some of those jobs are going away, right? Some of those jobs are going away with AI, and so they might not need cashiers. They
Well, right.
need
I mean,
dishwashers because they have.
the cashier is more likely than the dishwasher to go away, right? But sure.
You put all the dishes that
Yeah.
they can you spray it, and you don't need a lot of dishwashers.
Yeah.
Yeah.
And I don't know if this is getting into the weeds of your report, but do you guys take in consideration at all, like just the landscape of those, the ages of those entry levels, which is like maybe high school, that kind of stuff? Because the concern that I have is that with technology, social media, that kind of stuff, I think the reality is to acknowledge the fact that some of the work ethic is not as it's not as strong as it used to be. So do you guys factor in that when you're reporting? Like maybe these kids are so detached from personal interaction that they can't do basic customer service.
So I don't think we've ever tried to address that particular issue. I know in our last report, we had a box on what we know about AI. And there's been a fair amount of reporting that it's creating hiring obstacles or job finding obstacles particularly for younger workers.
And that's why
And-
there are so many working in 2 and 3 other jobs.
Yeah, but that's
Yeah,
not,
that's not new,
something going
right?
to what
Yeah,
you're saying.
yeah.
That's in DOE curriculum, I
Yeah.
think, on people skills, soft skills, all of those things. That's where McKinley Community School, they have the build your skills specifically for soft skill building.
Should be
And
taught
but we
twice,
gotta,
it should be.
you know, more data, then we can be more specific. Okay, go ahead, because you got like 8 more slides.
Yeah, we can, so this just basically points out that the job losses, and actually, if I were to update this, these are actual change in jobs from second quarter 2025 to fourth quarter 2026. So that includes history plus our forecast. And essentially, the biggest job losses that we were anticipating was in federal government. Minus 1,000, almost 1,600 jobs. We already saw that in the month of October. And actually, we'd already seen 1,300 jobs lost by the second quarter. So we were starting down and we've gone down further. So that'll get updated. The decline in state and local government jobs, that was really our forecast because of relatively weak tax revenue growth and some slowdown in expected state and county spending. The biggest contribution is in construction, as I have mentioned several times. So this gets at the construction picture and it shows our forecast. So and this data would be through halfway through 2025. So we have permit data, and these are all permits. The dark blue wedge is residential building permits. They're all measured in real dollars. We deflate them using the DBEDS Construction Cost Index. The wedge in the middle is non-residential permits. So think about when they build a condo on top of Ala Moana, that'll show up in non-residential, even though it's residential. So you can see that the residential permits have increased since, say, certainly since post-Great Recession, but the bulk of the activity is that big wedge on the top, which is all federal. And what we do there is we take the federal government contracts, like the $5 billion and multiple contracts that have been awarded over the last 3 or 4 years that are 5, 6, 7. The last one I mentioned was an $8 billion award that NAVFAC gave out. I believe it was in April or May. And then we take that and we spread it out over the expected spend period, right? So when you got the big award to do the dry dock, all the spending didn't happen in that month that the award happened. Rather, it's still ongoing, right? They're still working on it. And so that's how we get that relatively stable, high level of spending.
Carl, these are permits, but do you have the applications for permits? So we see how.
We do.
How long?
It's a mixed bag. We have, I think we still have permit applications for Oahu. It's hard to get that information from the counties. It would be really awesome if the counties standardized on the reporting of permits and included permit applications. It makes it, because
Housing committee bill.
we should talk, right? That's pulling teeth.
Because a lot of the counties outside of city and county, they're all technological related already. It's all documented. So I don't see how you folks can get the information.
So depends on their reporting system, right? So for example, and I'm not trying to call anybody out. In fact, I'm not even going to mention the county. There's a county that has the data on application date,
Right.
but they don't put it in any of their monthly reports or their daily reports. And we use the permit application date when we calculate how long it takes to get a permit approved that we publish in our housing fact book.
You don't want to show that. You don't want to show that it's been sitting on somebody's desk.
Yeah, so you could guess which county I'm talking about, but and so the only way I get the data is I have to ask somebody for the data every year and wait for it to get an email.
Okay, you work on that bill with.
Yeah,
Well,
Yeah, it would be very helpful. So because I've got 8 slides, I'll go more quickly. These are just our forecast charts. So you could see we were forecasting a very mild downturn in jobs. So we're talking about an increase in the unemployment rate of 30, 40 basis points, not much. And if the current trend continues, we're going to be completely wrong. The unemployment rate just keeps falling. But we still think that job growth is going to be very weak in 2026. And that's, similar. I think Joe talked about the risk to inflation. So inflation this is Honolulu inflation. That's the gold bars. And essentially Honolulu inflation throughout the year was on the way down. It started off in the mid, say 4.5% at the start of the year, fell to about 2.4%, 2.2%, and has been rising since then as some of the tariff pass-through starts to show up. We think that we'll see more of the tariff pass-through. Most estimates suggest that businesses have eaten a sizable, something on the order of 50% of the tariff. So in other words, they're shrinking their profit margins. And the question is, how long will that continue? It'll continue a long time if the economy is weak enough, right? Because they can't sell their goods if they pass through the price increases. So our expectation is we're going to see a little bit of an increase in inflation to around 3% in middle to say third quarter of 2026, and then start heading back towards a more long-term number. So it's not a huge increase. And then our GDP forecast was for 0 for 2026. That's likely to be too low. And we'll be updating that and that was basically based on a 2026 decline in tourism following a weak 2025. So I can skip over the long run stuff in the interest of time. There was a question about visitor spending long term. So this is a chart that shows real visitor spending going all the way back. So here's where we are right now. This must be quarter. I think this is monthly data. So that was probably September, maybe October data. And so you can see in 2025, when you adjust for inflation, we're below where we were in 2019. We're below where we were in 2021, 2022, and we're below where we were in 1989. That's the importance of deflating using a price index. So I'm going to stop there and
question with regards to Maui and the policy now with regards to vacation rentals. I understand there's a stall now because of the impact of the mayor's bill.
So the bill passed, right?
Right.
There's been a lawsuit filed. And there's also, I guess there was was it a TIG or a PIG, or there was that recommended modifications, and I don't think they've come back and met on those suggestions yet.
It's my understanding of those that do have the permits, but they're not renting out their accommodations because, it's pretty much stalled there.
Oh, I see what you're saying. You're saying that uncertainty or people are, okay. Yeah, I don't know. I mean, I can say that the overall tourism recovery on Maui has certainly been slower than I think many of us expected. I have no doubt that that's playing some role because it doesn't take much for visitors to be worried that, they're going to rent an Airbnb and then they're going to show up and it's not going to be available or something like that. So I have no, and on the owner side,
The owners of those properties are not putting it out on the market because of the uncertainty.
So I don't know. I'm not sure why. I mean, if I were an owner of a property, I would certainly be renting it. I don't know why that would be the case because Implementation it's not going to happen in 2026. I believe it's 2027 was when the first, and that was only a portion of the Minatoya list properties. So, how this, I don't think we'll be incorporating impacts of the Minatoya list issue in our next forecast report because it seems to me like it's completely unsettled at this point.
Okay, we're going to recess.
Quick question, Donovan?
Okay,
or-
quick question, because if not, we're not going to have a lunch break.
Okay, real fast.
We'll just keep going.
You skipped over Price Data Paradise, which is the population change. And it says estimated based upon birth and death. So it doesn't include moving.
So that particular slide, and for some reason I've lost control over.
Well, because it's lunchtime.
Yeah, that must be it. See if that did it. No, I'm not.
Well, we were supposed to be from 11:30 to noon.
So that slide
So-
is actually showing
20.
natural
Right,
population
okay.
change. And so it's literally
Projection.
births minus deaths.
That's next.
So it's,
And no moving.
well, yes and no. I mean, because if someone moves,
We're gonna take a break
it would
from 11.
contribute to lower
Well,
births,
then
right?
do
So
that.
if you have this many people living here, say you have 100 people
Yeah,
living on the
well,
Big Island,
it's-
and 10 of them move, then your birth rate, number of births is going to go down just because there's 10 people who can't. But I'm not adding in migration. I
Okay,
think that
all right.
answers your question. Yeah,
That's all I want to know.
yeah, so that's right. So
Big,
it's,
big island, but it's
That's
exporting out of Honolulu and every.
yeah, that's
and
exactly right. I mean,
Yeah.
the Big Island's population is growing,
That's
Right.
right.
but their natural population is
Yeah.
essentially zero, the natural population change. So it's not because there's more people being born than are dying, it's because people are moving in. Presumably to the Kona side, but I don't know that for a fact.
No.
It's-
You know, I'm gonna, yes.
So inexpensive housing.
All right. Thank you.
Okay, we're going to take a recess until 12:10. Recess. Okay, reconvening. Okay, next we'll hear from DOTAX, who will discuss revenue collections and projections. So good afternoon.
Good afternoon, Chair Dela Cruz, Vice Chair Moriwaki, in case she's watching, and committee members.
Yeah, she's coming.
Thank you for the opportunity to present our supplemental budget request for fiscal biennium 2025 to 2027. May I introduce the members of my team? If you could just raise your hands. Yeah, I'm going to introduce them then. Deputy Director Kristen Sakamoto, Special Assistant Gariyama Shiroya, Administrative Services Officer Min Ming, IT Services Office Chief Corey Higa, Taxation Services Administrator Nikki Thompson, Acting Taxation Compliance Administrator Madalena Lai, Tax Compliance Coordinator Susan Adamson, Tax Collector Dongyan Wen, and Tax Research and Planning Officer Baibars Karaka Avali. And at this time, I would like I guess I'll turn it over to Baibars to do his presentation.
Okay, good afternoon.
Good afternoon. Thank you for the opportunity to present. I'm the newly appointed Tax Research and Planning Officer, and prior to that, I was an economist in the Tax Research and Planning Office for 7 years, and an economics professor at UH Mana prior to that. So I will provide an update on the state tax revenue collections and the projection as requested. And as some background, I will be providing fiscal year 25 and then the current fiscal year, the first 5 months of fiscal year 2026 numbers, and try to provide some background regarding the tax collections and what goes into them. As some background, please note that the the fiscal year 2025 visitor arrivals were up by 3.4%, and general excise tax collections followed this pattern with 3.3% growth in fiscal year 2025. Then going into November 2025, for the first 5 months of fiscal year 2026, the GET collections were up by 7.2% compared to the same 5-month period last fiscal year. In fiscal year 2025, individual income tax collections were flat compared to the prior year at about $3.3 billion. And I highlighted the yellow section starting in January of 2025. This is when the new withholding tables went into effect in light of the Tax Cut Bill, Act 46 of 2024. So the decline in individual income tax collections starting in January 2025 is in line with the revenue estimates that we provided to the legislature for the Act 46. And that's part of the reason why we see a flat growth in fiscal year 2025. And to follow up, just to remind as a background, there were two significant tax bills passed by the 2024 legislature. And the first one is a multi-year implementation of an individual income tax cuts. Effective tax year 2026, the standard deduction amounts have almost quadrupled. So this started back in calendar year 2024 when the standard deduction amounts doubled. And then effective this January, they almost quadrupled from their original levels back in 2023. And the tax brackets have also been expanded for starting earlier calendar year 2025. And we took that into account by changing the withholding tables. So all the taxpayers have seen a less cut from their paychecks and retaining more of their disposable income. So given the progressive nature of our individual income taxes, the way these tax bracket expansions have been working is that it's giving bigger of a tax break compared to your tax liability, the lower the income. So although it has benefited everyone, the benefit is proportionally higher for lower and middle income groups, especially with the expansion of the standard deduction increases.
Can you go back to the GET?
Yes.
So which industry or industries generated the most GET? Or where was the growth? In which industries were the?
I don't have the precise numbers, but it's an overall growth. So not in a specific industry doesn't stand out per se. What we have is by business activity. So retailing is the biggest part. That's where we collect 4%. But overall, like all the sectors have been growing more or less at this rate. And part of it is, of course, the inflation is a factor, right? So these are nominal. So even if there was no growth in economic activity, you would still see an increase in GET collections based on that.
Yeah, so the economist previously had said that even though hotel room rates were flat, spending went up. So I just was trying to figure out how that correlates with what you're presenting.
Yes, so it would be mostly because the majority of the GET at the 4% rate is the one that would contribute to this amount. So that would be more in retail sales rather than wholesale activity. So, but I can get back to you with further breakdown.
Okay, and then the same for the income tax. Which industries provided a growth in income tax?
Again, we don't have a breakdown by industry per se. All I can tell you is that this is we have individual taxpayer level information. So the thing that having that access allows us to do is we're able to do whenever a tax bill comes up, we can look at the changes, how it's going to impact. But we don't break it down by industry. So that would be more for business income, maybe, but that's not something we track for the individual income taxes.
Okay, that's fine.
You. So going back to the current fiscal year 2026. So for the first 5 months of fiscal year 2026, as of November 2025, the individual income tax collections were down by 15.5% compared to the same period in the previous year. And this is in line with the revenue estimates that I shared in the previous slide. We had about an estimate of 600 million reduction in general fund collections due to the tax cut bill for fiscal 26. So this is already showing its signs. And understandably, it does get into it is part of the impact that will be coming up when I talk about the general fund. There's also other two significant tax bills that were passed by the 2025 legislature. The first one is relating to kind of closing a loophole, eliminating the double benefit of PTE tax credits to be added back to the qualified members' taxable income. That has about $30 to $40 million impact. And then the next one is the so-called climate impact fee, or the green fee that passed Act 96. It was discussed earlier this morning when I was following the testimony of DBET. So this increases the transient accommodations tax by 0.75% and also imposes a new TAT for the first time on cruise ships. The combined effect of these two bills was estimated to generate about 120 million additionally to general fund. Going back to the update on the tax revenues, though, the transient accommodations tax collections were actually slightly down in fiscal year 2025, about 1.5%. And then looking into what might be going in there, to give some background, this in part reflects the negative impact of the Maui wildfires in August 2023. As you can see in this picture, the dark blue region refers to the Maui County TAT liability, and it was down by about 22%, which stayed the same for fiscal 24 and 25. And actually, if you look at Maui's share, it has shrunk by about 7 percentage points in the last two fiscal years post the wildfires. So we're still seeing the impact of that. But for fiscal year 2026, the year-to-date growth is about 1.8% compared to the same period previous year. So this is in line with some of the DBET and UHERO numbers that were presented. Lastly, the fourth major tax collections are in corporate income taxes. It does show a lot of volatility, but it was down by about 17% in fiscal 25, and it is in line with the national trends. And the other thing that happened in 2024 was the pass-through entity tax was reduced from 11% to 9%. Although this is supposed to be revenue neutral, it created this previously non-existent tax that the partnerships and the S corporations would be paying. So that increases the tax collections that we monitor in terms of corporate income taxes. To give an idea, the magnitude of this is about 185 million in PTE taxes. Looking to the current fiscal year, for the first 5 months, we again see a decline in corporate income tax collections by about 16.4%. This is again in line with the national trends. The median state US states saw about 20% decline in corporate income taxes in the current fiscal year. And across the nation, the corporate income taxes are down in fiscal year 2026, primarily because of the post-pandemic slowdown in revenue growth after they've had record highs after the pandemic.
Can I ask you a
Yes,
question?
please.
With regards to that on the corporate income tax, you know those that are delinquent? It's not in this chart then.
These
Because I
are,
understand the last report I saw a couple of days ago, all those delinquency and collecting taxes seems like it was pretty much predominantly on corporate tax delinquency. But it wouldn't be in the chart
it wouldn't be, these are the actual collections.
section. Okay.
Yes.
So, why does the corporate tax of the fluctuation on their, taxes? Why is such a big, fluctuation?
It is basically the nature of the business cycle and seasonality of it. So it's better to look at it in totality. So like overall a fiscal year, it's and it does follow directly the national trends, what is happening in the corporate world, and any changes that might be happening in the at the federal level as well.
Can I ask a question?
Mhm.
So the delinquent taxes, is that in any of your charts?
These are the actual collections. So if it's not collected, then it would not be in there.
Have any in your presentation?
Not in my presentation.
Okay, so why not? And what is the amount of taxes that are in the rears?
Yeah, he's only doing the economic
Right.
component.
I'm
yeah.
just doing the
And then
revenue.
we can ask that of the department.
Yes. So for that reason, so no, not intentionally, it's just I'm talking about the revenue collections and the projections. So that might be a question for our director. Thank you. All of that was leading up to what's happening to the general fund. The general fund was up by 4.2% in fiscal year 2025. But I highlighted the September 2025. That was a one-time boost, about 315 million boost to estate tax collections in September 2024. Without that, the general fund growth would have been mostly flat. And leading up to that, so as we go into the fiscal year 2026, as of November 2025, for the first 5 months of the fiscal year, the general fund is down by 10.5%. Now, if we remove that, the impact of the one-off boost of the estate taxes, the growth would be negative 3.2%. And this is predominantly because of the multi-year tax cuts that are happening at the individual income tax level. So the projections do follow what the revenue estimates we provided, which are then taken into account by the Council on Revenues, which I will talk next. But if we assume 0% growth for the rest of the fiscal year in every month, we would end up at negative 4.6% growth year over year by the end of fiscal 2026. And this is precisely what the Council on Revenues forecast in their last meeting in September of last year. They're actually meeting today, so I'm gonna have to run back and run that meeting at 2 p.m. today. So the Council on Revenues might revise these numbers, but their current forecast currently stands at negative 4.7% for fiscal 2026, and it just means that they expect the revenues to stay flat for the rest of the year compared to the previous year.
So your prediction is that what council revenues is going to go down even further?
I have no idea. So we'll find out as they meet later this year, this afternoon. The numbers that I ran are based on what they forecast about economic indicators. So I do run the models, and then the models it seems like they're slightly more pessimistic, but we'll have to see what it's completely up to them. We'll find out later this afternoon. Um,
Okay, because
And-
depending on what they say, there's either gonna be maybe a little more cash than we thought, or we're gonna have to make additional cuts.
Correct. Yes. So this is where we are as of this this hour today. And their projection for the out years are taking into account all those legislation that I mentioned. So if there are any changes, obviously to legislation, these numbers are subject to change. We are Tax Research and Planning Office, we assist them in taking all these, the impact of all these legislation into account when they're making their forecast.
Yeah.
So this concludes my presentation, but if you have any questions, I'm happy to answer.
Thank you. Okay, Dotex.
Okay.
Yeah, which one is on? Wait, where is? Where do we go to?
The only significant supplemental request that we have is the funding for the tax review commission.
Yeah,
Um,
table.
If we go to table 4, then it's priority number 4. So last session, the tax review commission was given $200,000 budget for them to do their work. The members only got recently appointed, and so
Nothing in addition.
they're not going to spend the money in the current fiscal year. So we're just asking for the money to be shifted and given to them for the upcoming fiscal year. Everything else in our request is revenue neutral.
Wait, can you explain the delay again? What?
It's just that the members of the tax review commission were not appointed until recently. And so we have,
Confirmed yet too as well. Yeah, do they get confirmed?
they have to come up for confirmation on this session, yes. And so they will be meeting, I believe next week is their first meeting. But we're just asking for the money, their budget to be shifted into the upcoming fiscal year because that's when they're going to be spending it.
Okay.
All of the other requests on table 4 are basically revenue neutral.
Okay. Oh, wait, Senator Kim had a question.
Okay, thank you, Chair.
Go ahead.
Let it go.
Oh, go ahead.
Okay, the position for the Hawaii District Office, is that still not confirmed? Because I don't see it yet in the upcoming year. So is that a new position then, still going through the process?
The one that we requested, it's not in our, it didn't make it through.
Yeah, you have a position.
Budget and Finance didn't
So
approve.
not hired yet then?
No. So if you compare table 4
And that's what.
compared to table 6.
Okay,
So table 6 is what made it through BNF and governor's office, which is 0. So all they're doing is moving money they already had from one fiscal year to another, which is why it's flat.
And for that position specifically, we found another position within the department to redescribe, so we will not be requesting funds for that or establishing that position.
thank you.
Yeah, so you can see from table 4 everything they asked for and what the decision was. And then table 6 is what they got.
Table 10. So you have here transfers, interdepartmental transfers. In the middle of the page, you have HB 300 CD1, 6 positions were erroneously requested. What do you mean by erroneously requested and who requested it?
That was our mistake.
So
That was
how
our mistake. It should have been
how did you
positions.
erroneously ask for it.
we wanted the positions the mistake was that we had identified the positions as being under the IT section or the IT office when in fact it should be under the director's office.
So why was that mistake made if that's what was the intent? I mean, I don't understand.
It
It's
was,
your request, right?
that's
You're the
correct.
director and you want it in your office, yet somehow it got asked for and was in another.
Unfortunately, yes.
Okay. So then let's go to table.
I want to ask a question
ahead.
related to IT. So IT is, to me, is really important because of your tax modernization. And I thought that you had these positions and you were going to grow your own. And do you still have fast contract employees on board, or what is the status? Because to me, depleting the IT section is so important is critical. And I don't know why you switch positions to the director's office. What positions are being switched?
No, these are non-IT positions. And so they never should have been under IT. They do work closely with IT, but this is the business. They handle I guess the business part of IT changes or system changes. And so these are basically tax experts that, work within the department. They're not programmers or anything like that. And so they shouldn't be working under IT.
But in terms of what is done in your divisions, I see IT as a major division, right? For all of your modernization. So if you're taking positions out and putting in your office, what are they doing in your office? Because I see the operations as being really important to the department.
Yeah, so the 6 new positions that we created, these are the ones in question. None of these are developers or IT people per se.
What do they do then?
Table 18.
Huh?
Table 18, which is.
Oh, table 18, okay, table 18.
Well, maybe if I ask the questions might get clear.
Okay.
So the 6 positions that you said you erroneously asked for is on page 18. And so I guess the data privacy officer, and these are all exempt positions, right? These all exempt positions?
2 of them are exempt, the data privacy officer and the tax business analyst.
position
Correct.
are exempt. The others aren't. So who's doing this work now? Like
So
who is the privacy officer position, or who was doing that? Who was the business analyst position? Who was doing that?
So right now, the duties of the data privacy officer are being shared amongst multiple positions. The IT chief, our special assistant, and myself are all doing portions of that job right now. The tax business analyst, that is being done by the business analysts who are currently housed in the IT division. But the long-term goal was to move a lot of these personnel into the program office under the director's office.
But don't these people report to the director anyway? Not these individuals you're moving, but the heads of the departments that they work in. Right? Don't they already report to you? Like the planning?
Yeah.
The
IT chief, yes, for sure.
Yeah, and then these positions you're taking out, coming out of the tax specialists and, right?
So the program team.
Administrative rules is coming out of the administrative rules section, right?
So the program, the people who are currently doing the job of the business analysts are currently reporting to, they're basically reporting under the IT chief. And the thought is that the program office will separately report directly to the director because it's supposed to be a bridge between compliance and the operations section and the IT division. So we wanted to create another office under the office of the director that reports directly to the director.
Okay, so the information specialist coming out of the tax research and planning, right? That's one of them.
No,
Oh, that's different from the program.
yeah, that's different. That's someone that would be assisting the department with
Okay, so under the tax research and planning, you have these economists and you have an information specialist for 3697 And that's the position you're requesting to move into your office.
Yes, to create,
But the tax research planning already reports to you.
they do.
Right, they already sit in your office. I mean, they already, according to your thing. So why do you need this person now to be in your office?
They're not gonna be doing, the redescribed position is not doing anything related to the tax research and planning office, specifically. This information specialist will be assisting with external communications for the department. I guess could potentially help us with developing training programs and that sort.
And who is this person?
We haven't been able to recruit for the position yet.
Okay, so all of these 6 positions are gonna go in your office now.
I mean, they'll be organized under the director's office, but they're not gonna be in the director's office.
It just seems like you're trying to create this whole entity in your office for some reason.
No,
I don't know, it's like you're building a dynasty in your office.
no, the thought was that the business analysts are the tax experts, are the ones that will tell the programmers how to program changes into the system. So they're the ones that understand what the tax law change is.
So who are you talking about now?
Um,
Administrative rules or who?
No, the positions that we created, so the TSM program office basically is what we're trying to create. And that's the task. These are the guys that work directly with the programmers to tell them what to do. And so as Deputy Director told you, right now, those tasks are being shared among various people in the department. So the thought is to consolidate.
Where is that being done? Under what?
Currently they're assigned to IT, so they're all under the IT division right now. But what we,
Under ITSU,
yes,
under ITSU right now.
what we wanted to do was move them under the quality control office, which is already under the director's office. So we would make the departmental program officer the head of that quality control office and move the tax business analyst and the program specialist and those other positions under that departmental program officer, who the departmental program officer will report to the director.
But you already took somebody from rules and you put her in ITSU, right?
Yes, currently she is temporarily assigned to ITSO to
Taking somebody from rules to put into ITSU, and then you're taking from ITSU and you're putting into the director's office.
So she was in that position when we started at the department. So that temporary assignment had already been established, but we wanted to set up a long-term permanent office. And we thought that that position, that function that that person is serving right now would be better suited under the quality control office and the program office.
Okay.
Have you gone through a reorganization? Because it looks like you had this TSM program office, now you eliminated, now you're putting it back in, but you're putting all those people in the director's office rather than doing a reorg to say, how are all these functions going to relate? And if in fact they were in ITSO and they were feeding the information for the system to be developed, then it should be there. If not, another office coordinating all of across the board, but you need a reorg, I think, before just moving people around. That's what I think Senator Kim is asking about, because it seems a little erratic.
This would be a potential reorg because we would be moving them to another.
You should do that.
And we do have the proposal. I think we submitted it last year when we requested these positions, so we can resubmit the plan to you so you can see where they are now,
what you're trying to
and
do,
where they're gonna go. We can,
and the functions of each position, because you're moving people who are in different divisions and offices and just pulling them out, and it looks very erratic. That's all going to the director's office. So I think Senator Kim's point is that, you know, are you trying to create a dynasty? Are you pulling them all into the director's office instead of really operations?
No, okay.
So I think we need your proposal and justification.
Yeah, let me ask you, so you still have 8 rules specialists?
We have,
'Cause according to this.
we have
chart-
6. We should have 6. We gave up 2 last year.
So it's. And then the other one became a PIO. right?
Um,
Yamash-
My special
Yamashiro.
assistant, yes,
So he was the PIO.
that's correct. He does, among other things, he does PIO
Okay,
work for
so
us.
he was doing PIO only, right? So you took him from rules. So obviously, I don't think you needed all these positions, but obviously you took him from rules and you made him the PIO. Right? And then you paid him $100,000 when the PIO is a civil service position that was being paid $63,000.
He does a lot more than,
Can you just answer that? Because as the PI, don't you have a PIO civil service position?
I don't believe so. There's no PIO series,
Not in our department.
not in that department.
Yes, it is. PIO is a civil service position, BU 13, SR 24, annual salary $63,384.
Yeah, we don't have that
Okay,
in
you
our
have that
department.
now, but then you created a PIO out of this rules and paying them 100,000. Now you're moving them to your data specialist.
I'm
data
not
privacy
moving,
officer.
no.
No.
The data privacy officer, we haven't put out for recruitment yet.
It's out for recruitment right now.
It is? Okay, but we'd have to go through that hiring process.
Okay, so it's not slated for
No.
the PIO. So what is that position PIO is doing now?
So Mr. Yamashiroya, I like to call him my special assistant. He does a whole bunch of things. I mean, he supports the rules office. He is an attorney too, so he does handle all of the UIPA requests. He presides as a hearing officer over Act 204 violations. So these are the ones where the operators of short-term rentals are not posting their TA numbers. He also is a litigation liaison for our big litigation cases. He will help coordinate discovery responses and stuff back to the Attorney General's office. He does external communications
Where did he come from?
from the Attorney General's office.
What's he doing before that?
Well, if you want to go way back, he's from Chicago and was a police officer, but he's also an attorney, and he was the special assistant to the Attorney General previously.
Okay, so now he's a special assistant. So you took the rules specialist office, that position, and you're turning it into your assistant?
For now, I mean, that was the need of the department at the time. When it came in, we didn't have a PIO position. So all the prior directors, as far as I know, have been using those positions for that kind of task or whenever they needed it. So
Does these remaining 6 specialists have the necessary credentials?
they're all attorneys,
They're all attorneys.
except for the one that is working under IT, but she had been in the rules office for what, probably 20 years.
And she works for Itsu.
She has an accounting background.
Yeah, but what about your current secretary? Wasn't she one of these rules specialists before?
No,
Put her,
no, she was never a rules specialist. She worked, I think, in the rules office at one time.
No, she was temporarily last
Temporarily.
year in the rules office for that short period of time.
rules office. You placed her in the rules office until you had your secretary opened up and then you moved her into your secretary.
That's correct.
See, but it seems like you're using these exempt positions, and I think we brought this up last year. And then didn't you wasn't, you had Paiva in there as well? Kelson?
That was our previous.
And now moved into the Department of Health. I mean, there's these musical chairs you seem to be going around, and I'm not sure, do we really need these positions if that's the case?
We do. Absolutely, we do.
But yet you can take one and put it in it, so you take one and put it in your.
So for Mr.
Are you
Paiva,
gonna are you gonna add more positions? Because you had 8.
no, we're not asking
So
for
now you
any
can
more.
do it 6.
In fact, we gave up 2 last year.
Okay, so you probably didn't need it then.
We thought putting together the TSM program office was more important and a higher priority. So we're willing to give up 2 of those exempt positions for that.
Okay, so what exactly does these rules people do? The 6 remaining, what do they do?
They basically are the in-house legal support. They interpret tax laws, create administrative rules, guidance, tax guidance. They also help drive our department's policy on how to implement taxes too. So right now, they all have like I said, they're all lawyers except for the one longtime employee, but she is extremely knowledgeable about the TSM system and about taxes.
But you did fill some of these positions with non-attorneys.
I did not.
No, your secretary was there
Well,
early,
Yeah,
right? And then,
that is correct.
and then the person that you moved to Itsu also is not an attorney, right?
Not an attorney. When we came on board in December, it was on the eve of our first legislative session. We had no legislative coordinator.
Not an-
I'm sorry?
She's not an attorney. She was occupying that.
The one that was in the position for
Yes.
20 years. Yeah, she's not an attorney.
Not an attorney.
So how many tax informations, I have here your list of what you folks put out and how many you do per year. So there's only like handful that you put out tax advisories, right? Tax release information and so forth. And some of these were drafted not by these guys, but was drafted by your civil servants on the opposite side of the rules. Your technical staff side. Right? And they're supposed to be done by the rules specialist, but it was actually done by the technical staff. So again, what are these people doing?
No, I don't know if the rule specialists are asking for assistance from the technical section. I'm not aware specifically. They draft the drafts. It comes to the director's office. We review it for accuracy. Ultimately, I have to sign off on it. So it is a process.
Okay, so you should look up tax information release number 2023-2 on the cigarette tobacco license. It was done by, you'd have to do it now. It was done by your IT. And also your Hawaii tax advisory. This is for the television, motion picture and film industry. So, there are evidence on these, and that's why I'm bringing it up, because they only did 4 in that year, and 2 of them were done by opposite side. And so you had 8 positions there, and now you have 6. So
I do recall in 2023, we didn't have any attorneys at the beginning of the year in the rules office.
When we
So
first
that may
came
have
in,
been-
when we first got appointed, the rules office had no attorneys. We have since, it has changed. I mean, deputy director previously worked, she's an attorney. She previously worked in the rules office. And so she understands the need.
But is that,
How many of your attorneys have tax law background?
how many?
So how many attorneys do you have and how many?
I'll tell you, it's extremely hard to find that combination of someone with a legal and tax and accounting background. We have one new rule specialist that has that combination. I think the 3 of the others.
No, one other 2 was in the department before.
That's correct. I think she's a CPA as well.
You need tax law background because it's very complicated. So I'm just wondering, the expertise and the MQs, if you use them, should really have tax law or tax background.
We try.
So what do you have in your rules area?
That is a desired trait. We do have 2 rule specialists right now with tax law backgrounds, but as director mentioned, it is very difficult to recruit.
but
tax
did you
law.
include that in the MQs? Because how did all those people get those jobs without the background previous to you?
I believe when we came into the department, the job description or the MQs had been changed and they no longer required like that they be attorneys. So
now you're changing them back.
we did change them
it
back.
Yeah.
But then if you have in your MQs, they should have tax law background. Then you can always have an equivalent, but at least you say this is the standard so that you have tax law background versus just putting not any old, but an attorney in that may not know about tax law because it's very complicated.
So it is complicated. I fear that if we put it as a requirement versus a desire, that we wouldn't be able to fill the positions. When I went into the office, I did not have any tax law background. I did have legal background and I trained in tax law. But at that time, I know that it was difficult for the office to find tax attorneys, and that still holds true today.
But you do.
But it is a preferred
Are you
trait.
training them so that?
Yes, so part of the their duties in the office is to learn the tax laws specifically for Hawaii because we have unique tax laws.
And that's what's helpful to have an attorney, even if the attorney doesn't have a tax background, because the attorney has specialized training, it's, we can give them the literature, they can read it, they can read tax statutes, they understand it, they can read legislative history. It's just quicker for them to learn.
So what is the relationship between federal tax and state tax? Because you've got to connect the two, because you're implementing a lot of the federal tax. Is that an attorney or is it a tax specialist who does that? Because we should be aligned with the federal for most of it, unless we have different laws that we pass.
Yeah, I mean, it's helpful for someone to have
So
federal
does
tax,
our
income
attorney-
tax experience.
Is that an attorney or a tax law specialist?
So it does overlap in ability and knowledge. So a lot of accounting professionals are aware of federal tax concepts and are able to look up the IRS guidance. And but where the traits of an attorney really come in handy is because we have our own state statutes that change the federal laws. It's helpful to have an attorney who understands concepts of statutory interpretation and how to read case law and regulations to figure out how we deviate from federal, because we don't have.
So who does that in your office?
So that would be the rules office, the rules specialist.
And that person is?
So currently we don't have a rules officer. We have someone acting as a rules officer who is a rules specialist. And that is Garrison Kurth. He's currently in an acting capacity.
And that person's background is?
He is an attorney and he does not have tax experience. But again, he's not the permanent rules officer. He's just a rules specialist.
Who was doing it before?
We had another, our rules officer previous to that was Winston Wong, and he did have tax law experience. So we do try to recruit.
And what happened to the expert, the rules expert?
He left the state. He's no longer here.
You want to go back to the question on delinquencies?
Yeah, but I was not going to if I get to that. Okay. So going back to how many, maybe you get this information to us. Over the past year, how many temporary rules did these specialists produce? Unless you have that information now.
I'm sorry, how
How
many?
many temporary rules did these specialists produce? Because they do temporary rules, right?
Yeah, we can figure that out.
Okay.
There were at least two that I know of off the
Least
top of my
two
head.
Temporary rule. Okay, only two. And then these temporary rules are in effect for about 6 months before you have to go to a public hearing, right?
18 months.
Oh, 18 months.
Mhm.
So these attorneys and some who weren't attorneys, but they produced these rules and you only did two so far. But they go into effect, right? Without a public hearing, and the taxpayers have to pay whatever it is that they decide they're going to put through, right? That's how it works, correct? So they come up with these temporary rules. You have to pay X amount, or you have to do this, or you have to do that, and they have to apply for it, even though they're in existence for 18 months before it goes to a public hearing. So the public doesn't even get to comment, but these people who don't have tax background perhaps are making these rules that go into effect for 18 months without any kind of public hearing. So I think it's a concerning of what they're doing and their qualifications and background. And then you put people in temporarily or not into these positions that don't even have attorney, not even an attorney. So these exempt positions, and I know you told us last year on the 31.4.5 that you can put whoever you want in it. Right? That the director can appoint whoever they want. Right? You told us that. Because we questioned those positions last year. You recall that?
No, I think maybe there's a misunderstanding. I think if the question was whether or not the rules positions have specific MQs. I think what we're saying is that those are exempt positions. So civil service minimum requirement, those concepts don't apply. So we can definitely come up with a position description for the positions that have what we would consider our minimum requirements for them. And so I think that was what the distinction we're trying to make. So I guess what I want to impress is I don't want to give the impression and minimize what the rules office does. I mean, they have extremely hardworking people. They do a lot of work. When they're not drafting rules and guidance, they are constantly bombarded by emails, so questions from the public, legal questions that they help with internally. So when auditors and stuff have questions about, hey, if we take this position, is it legally sound? So they have a lot of work to do. So they're not just, kind of waiting around for the next rule to come in.
Because the way you've put positions and moving them around questions that. And my understanding from talking to people that many of these rule specialists don't have the background is asking your technical staff for help and asking a technical staff for the information and the answers. So that's what's going on, which raises this concern, because last year when we questioned some of these appointments that you made into these positions, secretary, this ITSU person that now is in ITSU, you told us and you cited 231-4.5 that gives you the ability to appoint whoever you wanted because they were exempt. You recall that?
I mean, I think I do have a level of discretion to utilize those exempt positions that way. I don't want to give them, I don't want to have you folks believe that we are just using the positions and leaving the rules office with not enough resources. That's not the case. So when we did utilize positions, those are either vacant. I mean, it's really hard to fill the positions to begin with. And it was really urgent matters that needed to be handled. And a lot of the duties that Mr. Yamashiro does, Mr. Paiva used to do, these are traditionally duties that are related to legislative work, which is what the rules office would handle, like testimony, basically the work of a legislative coordinator. But because we didn't have a rules office, there only were three bodies in there, two rules specialists and a rules officer. When we got there just weren't enough bodies to do all of that. So the director's office assumed a lot of those responsibilities just to get by. And so, unfortunately, we've been trying to build the rules office up the entire time I've been here. We make a couple steps forward, somebody leaves, we got to start again. So our last rules officer was kind of the unicorn. I mean, somebody that had a legal background, right? Wasn't a CPA, didn't practice as a CPA, but that passed CPA exams and was working in private practice litigating tax cases. And so, hired him. Unfortunately, he left to pursue his dream to become a federal worker on the mainland. So now we're starting again. So it's really challenging.
My understanding is he didn't have control over his section. And I'm not saying that these rules specialists were hardworking and aren't doing their job, but it appears that the way that you have been placing people in the positions raises that concern that they're not really, you're not really looking at this office and what they have to do. And they have to do very important things like temporary rules that are in effect for 18 months before it even goes to a public hearing, and the public has to abide by it. If you have people there that don't meet the minimum qualifications, and let me just read what it says under 231-4.5, that the Director of Taxation may appoint an administrative rules officer and administrative rules specialist as necessary to assist the administrative rules officers, not to assist your office, not to assist with legislation, whatever, but to assist the administrative rules officer, of which he's not making these determinations, you are. The administrative rules officer shall direct the adoption of rules related to taxes administered by the department, assist with issuance of tax memoranda and tax information releases, and perform other duties as directed by the director. The administration rules officer, rules specialist shall be exempt from Chapter 76 and may be legal or accounting professionals. Okay, so they're saying that may, and perhaps we should say shall, because certainly that eliminates the ability to just put people in temporarily that will be of convenience to the director's office.
And that's what we're trying to do. I mean, that's why we changed the requirement.
I don't mind that. I'm supportive when we change this to make those things specific.
All I caution you folks is that it's really difficult for the salary that we can offer. It's difficult to fill the positions. And so I would agree with,
Accounting profession doesn't necessarily say tax, so that leaves it a little bit broader, but at this point, some of these people don't even.
I would agree with you 100% that ideally, if we could get someone with both a legal and tax background to come in, that would be ideal. But you have to understand that if we cannot do it, we have to make a decision. Do we keep the positions vacant and not have any bodies to do any work? Or do we take a chance and hire somebody smart like deputy director who didn't have a tax background but had a legal background that proved that she could learn on the job and over time be very knowledgeable? And so, and a lot of times that's what we did.
But I think the language that Senator Kim read allows that same flexibility. It just says
Yeah.
legal or
But yeah, we're not saying
Tax
like in our
background.
situation, but we're talking situation where they don't even have a legal background, that these positions has been moved around and it's concerning. And so, you know, you're saying leave the positions vacant. No, but it's not to go put, if you asked us for new positions, if that's the case, then you should have just taken these positions and repurposed them instead of asking us for 6 new positions last year. And now saying you erroneously put it in a department. So that doesn't appear that you're asking for new positions. In essence, you wanted that last year, but you put it in another division.
That wasn't intentional. And so the whole point of having the program office not under IT is because a lot of times
Then let's see the reorganization before you start
Okay.
asking for these positions and then keep switching it around.
But the main reason is it's not best practice to have the business analysts that sort of tell the developers what the business needs of the department are to be reporting directly to the IT chief, because there is tension sometimes where the business analyst will recommend it programmed into the system a certain way because that's the proper way to do it and the right way to do it. And we don't want the developers to have a say and say, no, I'm your supervisor. I'm not going to do it that way. I'm going to do it the way the developers want to do, because that doesn't help the department. And so that's the rationale for separating them out.
Okay, so I just think the looseness of how these positions are being musical chairs needs to be tightened up. Okay, because you had someone that was who's your secretary now, was in the rules specialist and then was put in HR for a little while and had no credentials for that position either.
That person was never put into HR per se. So
Say, what does that mean?
what happened was at the end of 2020, about the middle of 2024, my then secretary was talking about retirement. And so by the time we figured out she was going to leave at the end of 2024, I was fortunate enough to get a commitment from my current secretary now, who was working at the libraries at the time, to come back to the department. So previously she had worked for the tax department for like 13 years.
Specialist position. I'm not questioning
It was,
she
yes.
good or not. I'm saying.
It was an emergency situation. We didn't have a tax collector. There were
Okay, you know what?
there are a lot of needs that I believe that she could fill and help us out with for a few months before she started as secretary. So that's what I did.
But you put her into a specialist and then
he did it.
you put her into HR per se, and then now private secretary. And again, I'm not questioning her abilities. I'm just saying that you as the administrator are doing all of these things. It brings into question because there's complaints about this coming out of the department. You're aware of that,
Would
right?
it fit in something in?
Right? You're aware of that.
I'm aware.
Yeah. Okay. So if I can
Thank you.
go on to the next table.
Secretary.
I think just ask one question. Sorry,
What's the
sorry.
secretary salary now?
But she's asking all that. I just like, no, are you guys undermanned right now? Tax office? Are you guys undermanned?
Undermanned.
Yeah, you guys.
Yeah, for sure. We have a lot of vacancies.
So the question is, you guys went from 8 to 6, the 8 positions that you guys had say that you guys only gonna use 6. So the other 2 positions, it was still funded or not funded?
One was unfunded.
Was unfunded. So what's the deal with the other funding positions funding? If you only took 6 and you were supposed to have 8.
We traded it for a different position for the TSM program office.
See, the thing is, I heard you telling that, everybody's an attorney and all this stuff, and attorneys can do all of these things, yeah. But again, they're not specialized in, a lot of the people that you're talking about now, even though they have the capability, they're not specialized in things that is very important to the people of paying taxes. You know what I mean? Just because they're an attorney, doesn't make, because they can navigate you, they're still not specialists. And then what they're doing is they're asking other people within your department to assist them in their job that they're getting paid way more money than the people below them that's supposed to be making the decision. You understand? I mean, I'm not gonna put somebody, just because you're a doctor, yeah? I'm not gonna put you, to do heart surgery if you're not a specialist.
Right.
Okay, you're a doctor. I'm not gonna have a veteran doctor come over here and go do, open,
What's your question?
surgery on somebody's kidney.
Question.
You see what I mean? The thing is, you keep using the pot, you say it about 30 times, but they're attorneys. Who cares if they're attorneys? We are asking if they're specialized in their job. Because you can be a doctor, but you're a dentist. Right? There's different, there's different attorneys for different. He could be on criminal attorney, for all we know. Right? I mean, we don't know. You talk attorney general. I mean, it doesn't matter if they're an attorney. While we asking you, saying that it's hard to get the position, then that's what you need to tell us. If the funding is a problem, you guys cannot get the tax person because of the funding. Then that's what we need to know. But don't say we get a hard time filling them because we cannot get them well rounded because it's hard to fill the position. And then you can do the maneuvering that you do. It doesn't help nobody. Maybe it helps you in your office, but it doesn't help the tax people that's waiting for somebody that's supposed to be specializing in tax in tax decisions. I mean, I don't know. To me, it feels like you're taking this thing lightly in a sense of the urgency of having somebody specializing in taxation. I think it's really serious. It's really serious, and to having everybody want an attorney that's not specialized, I think that's a slap in the face to the taxpayers. Really is. So I don't know how we can fix this as legislators, but if you're having problems filling the position, then you need to tell us in advance. I know you just said you just started, whatever, but don't just start filling positions because, oh, hey, Donna, you're an attorney. Hey, come over here and work with me. I mean, that doesn't help me. It doesn't.
Okay.
Can I go to
Yeah.
table 14? Table 14.
Doesn't.
Page 20 of 37.
Gen tax system.
What?
Gen tax system.
No, last.
Oh.
Can you explain the last item, tax 107? Max value $50,000. Outstanding balance $42,000.
This
This
is
is a contract with ESNA Inc. Contract between the Department of Attorney General and contractor to investigate complaints against the Director of Taxation. Explain that.
So there was a complaint lodged against the director, and DHERD and the Department of the Attorney General hired an investigator to look into those complaints. We are the funding agency, and that's why it shows up on table 14. I was the person who signed to authorize the funds for that, but it is the Department of the Attorney General's contract.
So is that standard that the Attorney General will issue or go into contract with an entity to do the investigation?
I'm not sure if that's standard, but my understanding is because it involves the director, it would be odd for the director to be the signing authority, so it was elevated.
The director placed on administrative leave like they've done in other cases?
I'm not aware of those types of cases or
Maybe
decisions.
that they immediately put on administrative leave. I mean, we've had other cases of where they've been asked to put on administrative leave, but in this case, we're not. And I will ask the Attorney General that question, but certainly that raises concerns. I mean, I'm not sure, does the Attorney General $50,000 for every investigation they do.
Yeah, but why is the investigation in your budget versus their budget?
Because it's concerning personnel of the Department of Taxation.
So why wouldn't you just delegate those funds directly to the Attorney General so they could manage it?
I'm not sure. I was informed by the Department of Attorney General and heard that this is appropriate.
Is there some kind of document that on the Attorney General asking you for funds, or you're asking the Attorney General?
There is just the contract with the Department of the Attorney General as the signing the department procuring the contract and as DOTAX as the funding agency.
So has this consultant been doing investigations in the department and talking to individuals?
I'm not involved in the status of the actual investigation, so
but
not sure.
They've approached individuals in the department?
I don't have personal knowledge of that or direct personal knowledge of that.
Can I poll everybody?
What's also interesting is that open-ended, so this started in October, so
Well, I
what's
think it's-
happening? You know, on the contract?
I think we got an update from the complainant saying that.
Chair,
Yeah, which question? Table 14.
in a sense, I just want to say that, I think ethically, anything to do with a personnel should not be discussed because it's already in the Attorney General's office. So I would say if you don't feel like you can answer, I think it's best not to. That's just my suggestion, being a former mayor and the guidance we have from attorney's office. But that's just my suggestion.
Thank you, Senator. I'm not
Yeah.
permitted, I'm not permitted to talk
Yeah,
about.
it's not our Juliana to worry about personnel. I think that's not in the best interest of this body unless it becomes a technical budget item. But I just want to add that.
But it is a budget item.
Yeah, but I just want to add that I'm kind of happy with the reorganization because we have administration changes many times. But when you want to reorganize your own department, I think you and the employees know best. And we approved your budgets
Wait,
last year
what's your
and the
question?
employees. So
Question.
anyway, I just wanted to share that with you coming from myself, whether it's a question or not. And another thing too is when you do the reorganization, I'm sure you also have to send it to the unions for approvals anyway, HDA especially, and if you have employees from UPW. So are they aware of this reorganization? Or the
I don't know off the top of my head. I would have to ask our
Okay,
HR
because
office.
I know when you do reorganization that they have to approve anyway, but it doesn't seem like you're at that point where you already are in the reorganization. I'm not sure.
But you started it already.
You have started the reorg.
Not yet. We're in the process of establishing the positions, but we haven't moved them yet.
So you have to present it to them anyway, so we're not ready.
Yeah, so we submitted the request in our budget to move, but we haven't actually.
Therein lies the concern. You're not even to that at this point, yet you're moving all this stuff around.
Yeah.
And the other thing I
It's
just
just
want to
stuff.
say
Yeah,
is that,
sure.
what I'm trying to say about the investigation is it makes everybody feel comfortable, and I'm sure also for the director to be sitting there and having all these questions, because these are areas that is sensitive. And I think that's why they normally go on administrative leave, because it's just not.
Or at the very least, that item should not be in your budget.
Yeah.
It should just be in the AG's budget or DHER's budget. Because then we ask you the question because it's in your budget.
That's probably the
But I guess the appropriate question is, where did you get the 50,000 from?
I had to ask our fiscal office, and we were told, I was told that we had funds available to
Carryovers
fund
maybe
it.
from all your vacancies?
I don't know the details.
Well, I think going back to the vacancy table, I think, when you take a look, I think when I was looking at just going through it, so this is table 11, what really is concerning me is your vacancies with the amount of your tax
90.
collection.
That's 90 vacancies.
Yeah, well, because I think in total for your tax collection side, I was counting almost like 15, 16 of them that's vacant. And I think those are the people that are supposed to be going after our delinquencies. And that's revenue for the state, right? And I think if we're not focusing on that side, I think I'm very, very concerned because I think we probably have estimates of what those guys can collect, right, in a given year. And so I think it's either we got to redescribe, we got to pay more, but I think the top priority has to be filling those vacancies, right? Because that's money out of our pockets. So what progress have you been making?
Yeah. You want to give the overall, we've made some gains in filling.
I mean, as a department as a whole, we have improved on our vacancy by a small amount. Collections, very minor amount as of last year to this year, and improvement in our vacancy. But it is a problem. It is an issue that is a priority for us. And you're absolutely right. There is a return on investment and a dollar collected per head. So it is a long-term and actually short-term goal as well.
Yeah. So for collections, it's been kind of a rough ride. When we came in, we had a tax collector who left at the end of 2023. And after that, we're unable to fill it with a permanent person until March of this year. So Wen back there is our new tax collector.
But why?
It's a hard position for whatever reason, we didn't have good candidates. And
So
we didn't make a
that might
collection of this
mean
year.
pay?
It could be, but I mean, if we adjust one manager's pay, then everybody's.
Well,
needs to be
but
adjusted
you're
amount.
making money for the state. So I think what my point is why aren't we getting a little bit more creative in the core areas where you're going to make money, right? If we're just going to be like, okay, well, it's going to be status quo and we're going to wait till somebody comes to us, then of course we're not going to fill the vacancies, right?
Well, and we lose money.
And we lose money. But I think the whole point is if you're going to do a reorg and make sure you're actually thinking outside the box to fill these positions, right? And don't be moving positions around. You got to really think through what exactly we're trying to accomplish.
So none of the attorneys could be in the tax collecting department.
Yeah, but
I mean, I suppose if they wanted to, they could apply and they could get hired into those positions.
You reworking them, how you like put them, I mean, you need them in what the senator just said, you need them in the tax collection area. How long?
The reorganization we talked about, it has nothing to do with the attorneys. These are the.
I understand.
Business
that, but
analyst?
you're putting people in certain areas because they have a title, right, attorney. So I'm saying is if it's collecting money, and you need somebody to fill the position for a while until you can fill it, why don't you fill it with those guys?
Okay, well, you know what though, just to put some perspective, if you look at table 11, the salary is 48,000.
This is what
So-
would be there.
So when I just want to make sure that when we're asking these questions, you can't, I mean, if it was like 200,000, okay, you have every right to ask that. But at 48,000, going back to Senator Hashimoto's line of questioning, maybe when you reorg, you have to look at that because if you can't fill those positions at 48,000, that's something you gotta reconsider. I mean, if it's better to have half those positions and double the salary than none of them filled.
Yeah.
Yeah, but is the money all there for these positions, or they took the?
Well, they took 50,000.
Where, they don't.
On the
know.
vacancy.
The total amount of the salary vacancies come out to 5.2 million.
The money's all there. But I don't,
Well, some of it, I'm not sure what,
well, that's a question they should answer. Of the vacancies, how much of that?
do you lapse that total amount?
Yeah.
The 5.29?
Min, do you know the answer? Yeah, I would have to get back to
Can
you.
we get that
Correct.
information?
Here, can I ask, can you contract on the collection part for delinquency? Do you have authority to contract that position out?
I do, and so,
Perhaps that
Did-
could be considered because if you lack the expertise on a tax collection and with payment, maybe, I think in the interest of the state, you probably have a collection coming in much sooner.
yeah, so we have contracted with,
At
in a law firm for out-of-state collections.
I think I remember.
So
that. It's
we just started making
been in
referrals.
place for some time now.
Just this past year, so we started making referrals in January. And I believe so far, I think they've collected about $2.5 million for us. It, it, it did take a while to get that ramped up, but, you know, referrals are being made. But then again, we need collectors to look at the collection cases to figure out which ones are suitable for referral. And so it's not that we don't do any work on those, so it still does require work in addition, so, but we're hopeful that we're hopeful that it's gonna help.
And you for the tax collector, because that's a difficult job. I mean, it's hard for people, and your salary at 48,000 is, I don't think you're gonna attract people. Like,
What if they contracted a law firm to
looking at the
collect?
compensation to attract a recruit. When I look at delinquent accounts, there's one for shareholder mystics that the emergence group. If it was collected as an individual income tax delinquent account of $20 million, a $48,000 tax collector is not gonna have the training or probably the strength to go up against this. So what are your MQs so that you can elevate the tax collection office so that you can collect? Are you looking at that as well? Because it is a major, as Senator Hashimoto says, a major area where we can collect what's owed to the state.
Yeah, and can't you consolidate some of these positions that would maybe not release any of the funds, but that would allow you to add more of a salary incentive to just condensing some of the positions? Can you do that? I mean, you have 2 full pages of vacancy here with the handful of tax clerks. Like, I mean, I'm just trying to be creative. If we're telling somebody who's getting $48,000 a year that he has to go after somebody who's $20 million delinquent, kind of hard to be motivated. And intellectually too. Intellectually too.
Give them a percentage of.
Oh, God.
Can I put this into perspective? So how many actual delinquent tax collection people do you have? Because I'm looking at your chart here, and there's a lot.
Yeah.
And if you look at the one that's paid $46,000 or $48,000, that's delinquent tax collection assistant 1, you only show 2, 4, 6, 7 of them as an SR 15. The rest are all 2s, 3s.
There's plenty.
3s. Yeah, there's a whole bunch. So how many of those positions are not filled?
We have 41 positions in collections,
41 positions.
14 vacancies.
41 positions.
We recently lost, within the last year, I believe, we lost 4 managers, 2 to retirement and 2 to transfers within the department.
So when you took over, how many people were in this department?
In collections?
Yeah,
I don't know off the top of my head, but I don't think there were vacancies, but probably not 14.
Because my understanding is they had a record month with those people, and they collected actually $1 billion in 1 month. The last administration. $1 billion in 1 month of delinquent taxes, which I think it was a record. But so you've got 40, so you've got what, 30, 20, cannot add correctly, 6, 26. You got 26 people collecting delinquent taxes and 14 vacancies, is that correct?
We have 20 collectors.
20 collectors. I thought you just told me you had 41.
Yes, it might be
total
office
employees,
assistant
yeah.
or something, you
Yeah.
know,
But
administrative.
if you're talking about DTCAs, delinquent tax collection assistants in 20.
Collectors.
I count more than that, though. I'm looking at delinquent tax collection assistant 2s. You got 2, 4, 6, 8, 10.
I mean, that 20 filled, yes. Is what I'm saying.
Delinquent tax collector assistant 2s, you got 2, 4, 5. Delinquent tax collection 2, 3. Delinquent tax assessment, another 3. You got so many of them in here. So can you tell me what is the average amount of delinquent taxes per employee they collect per year?
Mm,
You have that? Or you can get that information? Average collection per employee per year.
Well, you can sit right there.
So we have total, according to the org chart, we have 41, but right now we have 14 vacancies. And if you exclude tax clerks, we have 2 tax clerk, admin assistant, and 4 supervisors. So we are down to 20 active collectors that are delinquent tax collection assistant 1 and 2.
Can you tell us what's the average collection per employee?
About 2,300 to 2,500.
Sorry?
2,300 to 2,500
$300. They collect.
case per collection case. We're talking about
That's
collection.
not what I asked you. I asked you, what is the average amount of collection per employee per year?
I don't have that information because I can get back to you on that.
you
But
please?
each collector have their own assigned collection case, and that amount can be various.
Understand. But will give us an idea what their workload is like, how much they're bringing in. And
I can get back to you on that if you need a dollar count. I have
Can you
how
tell
much
us
each can handle.
How much do we have in the rears of taxes?
I'm sorry.
How many
Delinquency.
delinquent taxes? What's the amount of delinquent taxes we have so far? As far as your data is.
So while she's looking at that, for fiscal 25, collections brought in about 284 million. So if you wanted to do some
284 million when?
284 million last fiscal year. So if you wanted to divide it by 20 or so collectors, you could get kind of an idea.
So the year they collected 1 billion in 1 month, that surely even surpassed the whole amount total
24
1
for the
year.
whole year.
Yes.
Okay. So how do you folks measure up as far as past collections year to this current year? Can you get that information? Obviously, I don't think you have.
I'm sorry, I don't think I understand your question.
I'm sorry.
So when you started the collection year versus the last collection year prior to the coming in, that we can see that.
I guess a comparison of the total delinquencies and how much you collected from the total delinquencies over a period of time. So every year you can see,
Compared to the
yeah,
year.
in 2020, total delinquencies could have been 2 billion, but you collected 1 billion. 21 could have been 1.5 billion, but you collected 1 billion. What would be the comparison?
And what is the overall amount? Do you know that?
Oh, 1.1 billion, I think,
1.1 billion is outstanding
outstanding.
total. How much of that may have been written off?
Oh, no, that's the amount. None of that has been written off. That's the amount.
So there's no uncollectibles.
Oh, for sure there are uncollectibles.
So can we get that? Because usually that's what they say they write off, the uncollectible.
Well, that's what we're in the process of doing.
So there was a new law that was passed this last session, that after 15 years, the debts are going to drop off. So we're currently in the process of, because that's going to have a January 1st, 2027 live date. We're in the process of going through all of those old debts and removing them from the collection balance. We don't have the amount at this time, how much it's going to drop off. We're currently working on that.
So is that a 15-year mark from the time that they were delinquent, or 15 from when the law took effect?
It's from the time of assessment, but there was a law that was passed in 2009 that made everything expire in 2024 that had existed before 2009.
Do you have numbers of how much of that we would be losing?
Not yet. We're currently in the process of working that.
So we want to see what losses, what I say write-offs get collected.
Yeah, and when you use the term collections, are you referring to also wage garnishment?
Could be.
Yes. Okay.
Yes.
Senator Kidan?
Yes. Do you have the authority to publicly print names in the newspapers of those who are delinquent?
Well, they did.
It did.
Yeah.
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 And it didn't.
By
bring-
statute, we have, I think we have to furnish a list.
Yeah, there's a whole list right here.
And you also have to include the date as well.
So,
Yeah,
so.
the starting date.
I think so.
Yeah. So does that, do you let them know that you're going to do that beforehand to see if that fits any?
I'm not aware of us specifically notifying them that we're gonna publish their names.
So we didn't publish it. We released the data pursuant to a UIPA request. But yeah, we didn't notify every taxpayer about the fact that the list was going to be published by the news.
So it's published, what, once a year? How often?
So we actually don't publish anything. We keep a record that if the public wants to inspect the role, we have it available to
Well,
them.
have you ever tried? I mean, I think if they know they're going to be embarrassed by publicly, publishing their names and that they are tax risk or whatever, that maybe that would encourage them to pay their bills.
Yeah, and as far as I'm aware, we had never published it, and I think this was the first time that I know it had happened, but I understand the concern about.
Yeah, well, Civil Beat has a database that they posted.
I know,
You
but
can just
not that
research
that
up.
many
Yeah, just
people
recently.
read
So I think they're the ones
yeah.
who did the UIPA request, right? And then they, and therefore turned it into a database searchable. So it's out there, it's public record. And searchable.
Okay,
Well, it's
any other
coming from
questions?
the-
Because we're gonna set the financial plan pretty soon. Yeah, go ahead.
Okay, how often do you evaluate or performance evaluation?
How often?
Yeah.
I've only done it last year,
Okay,
once.
So 2025 was the first time in
See,
2.5 years.
That's correct.
Okay, and did you set goals for your manager before you did the evaluations?
I did.
You did?
No, not before 2025, no.
Okay, because you're supposed to set the goals, but you just issued the ratings at the end of the PAS period, but you're supposed to set the goals before, so the managers know what or the people being,
My understanding is
the
that
goals.
there are criteria I cannot, because I didn't do goals ahead of time, I cannot make up goals now and then dock them for that, but then I can choose to score them without having goals in place by just using the criteria in the form, and scoring them that way.
You did performance appraisals, and did you use these appraisals to build a case against certain employees?
No.
No.
Okay, any other questions? Okay, we're gonna recess unless UNF is ready. Okay, why don't we do 1:50? We'll reconvene. Okay, reconvening. Next we'll hear from BNF, who will explain the administration's financial plan. Good afternoon.
Aloha, good afternoon, Chair Dela Cruz, Vice Chair Moriwaki, members of the Senate Ways and Means Committee. It's an honor to be here for the first time in my capacity as Acting Director of Finance.
Since baby.
Yeah. Been on the job for 4 weeks, so I'm still getting up to speed, but we'll look forward to delivering a really informative and helpful presentation right now. We did submit a detailed testimony, detailed written testimony. I've sat through several briefings where the director reads the entire 25 page testimony. It is harmful it was hurtful. So just to save time and hopefully boredom, I will be delivering this presentation in PowerPoint. But all the details are there, and if you have any questions about the details, we can answer them at that point. What I will be going over is the FY27 supplemental budget and the general fund financial plan. I'm going to be covering a couple things: the administration's priorities, the budgetary considerations, FY27 supplemental budget, and the general fund financial plan. So it's always important to start off with the administration, the Green administration's priorities. He wants to improve the overall quality of life of Hawaii's people by making strategic investments in the following: housing opportunities, access to healthcare, educational equity.
You want to
I'm sorry?
update this?
Oh, sorry. Thank you. Yeah, thank you. Educational equity, environment, and government responsiveness. All of this is, cost of living is a really big issue for all of us. The reason I'm mentioning all of this is because these are the lens for which we make all the tough budgetary decisions, right?
We broke this down. Do you have a dollar amount for each bullet point?
I do not.
Okay.
The other really important considerations that we had were, the econ briefing was this morning. I'm sure all of you guys know that there's huge amounts of uncertainty coming from the federal government that we are dealing with. That has implications in terms of what our responsibilities as a state, as well as economics. All of this is to say that this really affects our general fund projections, and I'm going to be going over that in a little bit. Another important point that I want to highlight is the state reserve policy, right? So there's a state reserve policy really informs how we make our financial plan. And there's two big aspects of the financial, these are goals, which is we want to have a 5% general fund carryover balance, and we want to have 10% in the daily rainy day fund. That's the EBRF, right? If we don't have 10% in the EBRF, the goal is 25% if you add those two numbers together. If we do have 10% or more in the EBRF, we want to have 20%. Right now, we have 14.4% in the rainy day fund, which is the largest ever. And so which means that 20% is our goal if you add those two numbers together. That's how we're going. Another very important consideration are state liabilities and fixed costs. So these are pension, post-employment, debt service. This represents 47% of the general fund budget. And these are things that we can project going forward, and we included those in our financial plan. Those are kind of strategic considerations, but I also want to highlight what's changed since the last time we made the biennium budget last spring. Since there's lower than expected growth. The growth, as you saw in the econ briefing, it's better than what we thought in August, September, but it's still not as good as it was in March. COVID stimulus money is over. The reason I include this is because for the last, we're in 2026, 6 years out of the COVID, after COVID, but from 2020 to about 2024, there was a lot of COVID money moving through the system, and we saw that in our economy, in our revenues, but also in our funding. That is gone, so we're going to a lower baseline than before. The feds are pushing more responsibility onto the state. This is a big dynamic shift that is occurring so we're having to assume more responsibility than before, which drives up costs. There's high levels of uncertainty. So like the federal government shutdown, when the federal government shut down, the state government had to step up, and that required money as well. So in all this, I just want to highlight we have lower revenues and higher costs than before, and that's what we were doing. And every day seems different now, and so we have to have higher levels of budgetary agility. So this is really where the rubber meets the road with the core forecast. So let's see, hopefully you can see this. So March 12th was the last time we made the general fund forecast, or the core made the general fund forecast, and the biennium budget was made. There's been 2 core meetings since then. Right now, the core is meeting as we speak, but the last time that they met and provided a forecast for September 4th. So if you look at from the difference between this bottom number is the difference between the September and the March forecast. So the changes in revenue, this is how the revenue has differed from the last time we budgeted stuff. What you'll see is in 2026, and 27, it's 315 million or 315 million, 410 million. So this is 3-4% of the general fund. If you go into the out years, it's over $500 million. In total, over the budgetary period, is about $2.8 billion. So we have $2.8 billion less than what we did last time we formulated the budget.
So how much would we have saved if the governor didn't veto the tax credit bill
The
that
tax credit
ended
bill.
tax credits in 5 years?
My recollection is of that bill was there was no revenue impact because everything occurred outside the budgetary window. For the one that
I'm
said
talking
that,
about the 6 year, but 6 years, you're here at fiscal year 2032.
yeah,
So that would have been within 5 years. It would have affected the last year.
it would have, okay, so last year we didn't have 2032, we only had 2031 in our budgetary window. And if I remember correctly, and I need to go back and check, I'll check and I'll respond to you. So anyway, we have higher costs imposed by the federal government and lower revenues. With that, we formulated our budget. We knew this was going to be a lean year. We've asked all of our departments to limit new requests and work within existing budgets. There is some additions. Most of that is stepping up where the federal government stepped down. And that's responding to the one big beautiful bill in terms of we're responsible for more of the administration costs of SNAP and for Medicaid expenses. Oops. So here is a breakdown of the supplemental budget by department. This is for all funds, not just general funds. What you'll see is $19.7 billion in 2026 and $20.4 billion in 2027. The largest portion of the pie is budget and finance. That's a lot of our fixed costs, and I'll go over that in a little bit. Yeah, followed by health and human services, education, and health, and then
the
transportation.
opposite.
Yeah, health and human services.
Human services is 24.
Oh, human services, I'm sorry.
And then buff is 21.
Yeah. Thank you for pointing that out. And we are, the proportions stay relatively the same between 2026 and 2027. This is showing us just for general fund numbers. And in 2026, we have a budget of 10.4 billion, increasing to 10.6, a very modest increase to 2027. The largest expense is budget and finance, followed by education, and then
That's not too low.
health and human services.
A little bit less.
This is of supplemental asks.
So here is just to go as to highlight that 47% of our general fund budget goes to fixed costs, right? This is retirement systems, debt service, health fund, Medicaid, and Medicare expenses. 53% is the non-fixed costs, and a large portion of that goes to salaries. Here's a CIP budget for fiscal year 26 and 27, a breakdown by department. We are budgeting $1.5 billion in fiscal year 26 and fiscal year 2020, 1.3 in 2027. The largest is education, followed by deep ed, and you can look at how it breaks down after that. So here's a financial plan. I'm going to slow down and really talk about this because this is like a hard slide. Hopefully you guys are all very familiar with the financial plan, but I just want to break it down to something, how to understand it, right? So we got revenues up top, expenditures below, and the differences between. So you can always think about, we got all the money coming in, all the money going out, and what's the difference?
We got it.
Okay. So what you'll see is the revenue over expenditures, which is the difference, is for fiscal year 25, it's positive, but you see these negative numbers. They exist, and around 30 and 31, they go up. And I'm going to explain how that happens. Correspondingly, the carryover balance, as you can see, starts
at a healthy amount of 2.1 billion. And it decreases over time, hitting a low point of fiscal year 29. And
The
then
lapse number seems to have increased.
which one?
250, 250, 250.
Okay, yeah. So
Because previously it was 40.
right. So that represents the lapses. So
So is that how you playing with the budget? You just increasing the lapse number?
the lapses, we went back,
110 million.
we went back and looked at the average lapse amount over the last 5 years, and it's 250 million. And that's what we put in there.
Okay.
So, okay, so here's the ending balance for fiscal year 2025. We're at 19.9, and we, gradually decreases to 8.1 and then increases. So I just explained to you that we have $2.8 billion left in the budget, and we're having to assume some more expenses. So how did we accomplish that? One is what the chairman pointed out, is we made some adjustments to the lapse amount to, we think, make it a more practical, reflect reality. The other thing,
Or we could just not give the amount that's asked and give what's needed.
that's absolutely true.
And that way it's more transparent.
So just to point out, okay, so 250 million is, that means we have a lapsing amount on average of 2.5% of our general fund balance. I think I'm happy to work with you if we think that is too large and we want to narrow that amount. So how do we do this? A big part of this is like somewhat lower revenues. We also asked our departments to live within their means, which means that the operating budget, operating expenses do go up, but these represent mainly fixed costs that I was describing. It also reflects collective bargaining agreements. The ones that are not included are BUF 5, 11, and 14. So that will also have to go in there. The current collective bargaining agreements go until 2029. So they will be renegotiated at the very end of this fiscal plan. The other way that was really important is if we look at this other revenues line right here. So in fiscal year 26, that we have 550 million, that represents the Plavix settlement. And then you'll see 2028 increasing to 2031. There's some increases in revenues. This represents, there's a number of pieces of legislation, but the big components of this is a modification of Act 46, which is a tax cut law in the out years.
Mhm.
And by also supplying tax credits to working class families and Alice families. So with that, what I really wanted to highlight here is we decrease to 8.1 and we increase. It would be we wouldn't be able to balance this financial plan without other revenues, right? So that's why we're here and that's what we're talking about. But it's really important for the financial health of our state to have decent carryover balances. So we have some wiggle room. Like we said, we're facing an incredibly uncertain economic environment. For just wrapping up now, the proposed budget appropriations are below the expenditure ceiling. If you look over here in section B.
Do you have a copy of the bill?
The copies of the bill will be delivered on the State of the State, which I believe is January 24th.
But I guess, can you share some of the assumptions of when it takes effect? Or is it are you guys baking in something this year?
No,
Do you have
no.
a chart of how you come up and with who's affected, how much we're not going to give who's affected to generate that much amount?
Yeah, we can work with the Department of Taxation to provide those numbers. But the thing is, we're going to pause all the existing tax relief. People get to keep, right? And anything that's happening this year, we have additional tax relief that's went into effect. People have adjusted the withholdings. That's going to affect all year. The proposal is starting in January 1, 2027, there will be a modification, a pause of the tax bracket adjustments, and that going forward. We will also have,
Yeah, so we would want to see the breakdown of
yeah,
that.
we can absolutely provide that.
And who's going to get affected?
Yep, we can work with the Department of Taxation to provide that information.
Because I thought the last statement was it's only going to affect the wealthy.
We have, the way that it's designed in the tax package is it's designed to provide, tax relief through tax credits to Alice families and working class families that offset that. So with the architecture of the Act 46, right? Relief that occurs to somebody making 50,000 also occurs to somebody making 150 for the first 50,000 of taxable income that's taxed equally, right? In order to modify things, we're providing tax credits to ensure that working class families still get benefits and still have lower tax liabilities, while higher income households will not get the full benefit.
So they would have to apply for the credit.
No, they don't have, depends on the credits. We're looking at, it depends on the credit. These are all credits that exist within our tax system that you guys are all familiar with, that we're just.
Yeah, it's just that Alice and low income families tend not to apply for the tax credits.
Yeah.
So that means you're providing the tax credit, but then a lot of that population
Don't file taxes.
don't end up
Yeah.
getting the credit because they don't apply for it. And so
And they don't file taxes.
they file taxes. It's just that they don't
They're-
they're not saving every receipt. They're not doing all of that.
Yeah,
So they get credit.
the tax credits that we're looking at is not dependent on receipts, it's dependent on your income, right? So if you say like, oh, I make
You
20,000.
gotta just send the bill.
Okay.
Because then
Well,
we're just all
Yeah.
speaking hypothetically.
Sounds good.
Consideration, when folks take into consideration the fact that we made a concerted effort to lower the taxes for our residents, and we made a big deal. Big deal about it. And now we're into it by what, a year, 2 years, and then you want to pause it.
Yeah, but
And so that's good, the like planning practice to do that. So he shouldn't.
Yeah, I understand your frustration. I don't think any of us wanted to be here, but like the financial plan is,
So if we don't roll back or pause the taxes, what areas can we do to minimize impact?
You could take
Before we looked at that?
you could take the lapse and increase that, but
Yeah, no, but I'm just asking.
that's what they did.
Are we looking at one more efficiencies and government? Are we looking at streamlining? Are we looking at cutting out waste? Because there's a lot of waste that go on. Yeah, I don't hear any of that. I only hear about, telling the taxpayers, either we're gonna tax them or we're gonna cut out the taxes.
Vacancy savings, you guys.
yeah, Senator,
And did you guys look at vacancies to cut vacancies?
not in this particular budget. And all I can say is I'm very interested in those questions as well, so I'm happy to work with you guys in looking at that.
Yeah, but you're putting out this to the public. The general public is not gonna be happy about this without us even looking at where
Yeah,
are the areas we can save
Yeah,
money.
if we're gonna ask them to tighten their belts again, then we gotta tighten ours.
Absolutely.
To look at programs that may be self-sustaining or able to generate revenue, and we're not looking at that. As is, all we're looking at in the biennium and these budgets is what are the new asks? Then you ask, we're not evaluating what we're currently spending, and that needs to be done, and that's administration needs to.
And when we say tighten our belts, it doesn't mean you buy bigger pants so that you can tighten.
But have you gone into
That's
the
great
base?
for-
Have you guys gone into the base to look where you can cut?
To my knowledge, there was no large cost cutting exercise made.
Okay, because when we had the major disaster fund, a lot of monies were transferred from departments to the major disaster fund. So none of those departments said anything about the impact they had
Okay.
that when those money got transferred from their department to the major disaster fund. So that leads me to believe that they can do without that money.
Yeah, again, senators, I'm 4 weeks on the job. All these things sound totally reasonable, and I'm happy to look into it and have an honest conversation with you about them.
Okay,
We're gonna get the phone calls, not you.
well, people are already asking all of
Yeah.
us about the tax bill, and so that's where we're asking these questions because we can't explain it. Okay,
So just to wrap up here, the general fund appropriations are below the expenditure ceiling set out in the state constitution. You can see the numbers here, all branches of government. These are the proposed budgets, fiscal year 26, 27, 11.4 billion and 11.58 billion. That is lower than the expenditure ceilings of 11.9 billion and 12.6 billion.
We kept raising the expenditure ceilings over the years.
The expenditure ceiling is based on a calculation of total personal income and a calculation that is set out in terms of the state constitution. I did not include that, but we are also in this, I did not include it in the presentation, but it is involved in your in the text of the testimony. We are below the debt limit, and their attachment 3 of the debt limit explains all of that as well. Article 8, Section 6 of the state constitution says that whenever the general fund balance exceeds 5% of general fund revenues for the preceding 2 years, the legislature must provide a tax refund, tax credit, or make a deposit in emergency funds. We've hit that benchmark for 24-25. So this is just to advise the 2026 legislature that we must provide a tax refund, a tax credit, deposit into emergency funds, or prepaid some of our debt service or pensions.
It's on our tax relief that we're given, and now it says, yeah, we have to give them a refund, which you probably stop telling us we should be putting into the radio.
Well, Senator, I just want to point out, like, the reason we have a healthy carryover balance right now, right? And we're utilizing that carryover balance, and that's actually helping us get into the out years. I understand to constituents, they don't understand that at all, and it's very hard to explain, but
What they don't understand is not this. They don't understand how we can boastfully talk about how we're gonna reduce because of the economy and because of inflation, that we're gonna go back on what we promised them, that they would get tax relief. That's what they can do.
okay, any other questions?
Just, for the budget, for financial budget responsibilities, are you guys gonna be requesting funds to spend on programs that would provide, I'm not sure if you have the answer for this, to provide benefits for the people of Hawaii and the Hawaiians? Because you guys talking about the financial situation is exactly what Senator Kim said. We was happy to put in our flyers and let everybody know how much we're gonna work for the people and got them a tax break, and then now we got a tuck tail. So is any of this in a forecast that you guys are gonna make sure that the people of Hawaii is taken care of?
well, this is not my understanding is the breakdown by a budget by department is, those are good questions for department by department.
No, I understand that, but see, when I was just listening to my colleagues over here is that, we're gonna go back on what we said, and then you don't even have a forecast on how much wasted money we have in vacancies. You don't even have that into the factor, you never pencil that in or anything into the factor of how much wasteful spending government is, and then we will tell the public that it's okay, but we will take money back from you. You see what I mean? That's the thing that Senator Kim is saying, because they getting the phone calls, we won't get the phone calls. How are we gonna explain to them if we didn't go after the departments, like you just said, it's gonna be a department question, right? But how are we gonna go to the department if you guys don't even have a clue on how you guys are gonna factor in the money that we're spending in these vacancies? That's a concern, big concern. Do you even know the amount that we're spending on these vacancies?
No, we don't have a fixed amount.
You don't think you guys should know when you guys doing something like this so that we can let the public know?
We will get you that information.
Appreciate it. Thank you. Thank you. Chief.
Questions?
Yeah, about the financial plan.
Yeah, yes. In your report on the supplemental budget for fiscal 2027, you're including a bill, an emergency appropriation bill.
Yes.
And including the funding for $98.9 million for the temporary hazard pay. And it says the appropriations are necessary to provide critical support for the respective programs this fiscal year. What is that all about?
So,
COVID?
yeah, this is the COVID, it's a leftover, it was, the expense is larger than what was budgeted.
Are you committed to doing it this year?
It's budgeted this year.
No, so this was negotiated with the unions.
Yeah.
And so that's where,
So he has to spend it then?
no, they have to pay it.
Yeah, they
have
have
to
to,
pay it.
they
Yeah,
have to
yeah,
expend it.
Yeah.
No, but the thing is, you guys negotiated with their contract, especially when it came to UPW. The thing was negotiated, but now they're going back on their word and giving them the money. So what we need to know, even from you, where did that money go? Because the people at the school, custodians and all of those guys, UPW, according to the contract that they had rectified to going forward on their contract, they agreed that they was gonna get that payment. And now the DOE is saying that they're not gonna pay them because they don't want the money. So somebody needs to tell them where the money went. If you're saying now again, there's still COVID money, which that's what they believe.
No, that's not COVID money. This is a settlement
Yeah, the settlement that, yeah,
between
the
the
settlement
unions
that they
and the
said that
state
to those
for hazard
workers.
pay.
Yeah, they never get them. And it was promised them during negotiations on
Yeah.
their contract, as they wouldn't have rectified the
So
contract.
UPW has been paid or no?
I'll look into that and I'll get
But
back to you.
That's the DOE, now you gotta make sure you specify, it's the DOE workers, the
Have all the
custodians.
unions been settled then, that could settle? Because some contracts did not have the hazard pay clause, right?
Yeah, my understanding is part of this 98 million is like the ones, the,
The ones that had the clause that didn't get settled.
yeah,
This
yeah,
is the rest.
yeah,
These
yeah.
are the rest.
That's my understanding.
So was UPW part of, did they have that clause in their contract?
They did.
They did.
Okay, so that's been settled.
The reason I ask and bring it up, it's $98 million. So in the public's point of view, because we're hurting right now, and to know that this is going to go out, even though we had a contract or there's a contract with the unions, but it's not going to be well received. I just wanted to share that.
I understood, Senator.
Oh, but the clarification, what I'm trying to explain to you, it was told to them while they was negotiating a contract that they was gonna get that hazard pay. And then Kurt from the DOE or whoever's within the DOE told them now there's no money.
No, can you get that in writing?
Okay.
And then we can forward that to them.
Yeah, okay.
Okay, any other question?
Yeah.
Senator Kim?
So can you also let us know what would the impact be on $1.6 billion worth of encumbered funds with the DOE, the CIP, that's sitting there?
I want to understand your question, correct. What is going on with the 1.6 or?
That impact our,
Okay,
the bottom line, if we didn't have that money sitting there.
Yeah, but UH and DOE have reserves, right? And aren't their reserves much higher than what's required?
Well, how does the reserve deal with the?
No, but there's the difference between CIP and operating though. So in with DOE and UH, they have operating reserves that are above and beyond what the minimum that's required. And so I'm not sure if any of that money has been transferred over to the general fund.
I don't think it has, no.
In case of UH, it's tuition dollars, which they're allowed to keep.
I don't know, the emergency reserves for UH are strictly tuition dollars, or are there any general funds that are included?
We can look into that and get that back to you as soon as possible.
And then, did you guys have a chance to review all the special funds with high balances? And why aren't we looking at those to try to balance the budget?
Again, I look forward to like those, that sounds appropriate, given the situation. I look forward to working with you on those issues.
So my understanding is if we go into arbitration, we were to go arbitration for any of the union contracts, they look at the amount, the ability for us to
Payment, yeah,
pay.
yeah.
And so the more money we have in reserves, the more money we have, that the more likely that arbitration will give them the higher amount. So we try to tighten our belts, and yet it ends up going out in another door. And it's at the expense of the people that we promised we were going to give them tax relief. So I don't know if you guys are even looking at that.
Decision.
Okay, this should be very fruitful next 20 days. Okay, any other questions? Okay, thank you.